Chapter 1. Introduction to the Art and Science of Technical Analysis. Technical analysis is a fascinating field of study. It is as much science as it is art. Its main strength is that a lot of it is visual, giving practitioners a better feel of the underlying dynamics of the markets. Main objective of technical analysis. It is generally accepted that human beings are born with certain instincts, tempered and molded by evolution via the passing of time. Instincts are 1. The instinct to survive. 2. The instinct for comfort. 3. The instinct to propagate. The instinct to survive is probably the strongest and most overpowering. Survival almost always precedes the need for comfort or to propagate the species. The instinct to survive includes the instinct to stay alive, the instinct to satisfy hunger, the instinct to seek safety, that is, being in a group, herd, the instinct to avoid danger, by having natural fears like the fear of fire, loud sounds, heights, etc. This powerful instinct to survive is the main driving force in life for striving to make a profit. But in order to make a profit to ensure continued survival, there must be a positive change in the actual or perceived value of something that we own. This change in value of some variable may be anything that will allow us to profit from change, which is to always buy when prices are low and sell when they are higher, popularly referred to as the buy low, sell big principle. See Figure 1.1. Unfortunately, in order to satisfy this simple rule of guaranteed profitability, we need to be able to do more of one thing, which is to be able to determine the direction of price ahead of time in order to know exactly when to buy low and subsequently sell higher. Hence, it is not only the mechanical action of buying low and selling high that counts, but also the timing of the action itself that is critical. Profitability therefore requires effective and efficient action in two dimensions, that is, price and time. 1. For identification, it identifies and describes past and present price action. It serves as a historical record of what has transpired in the markets. It provides a descriptive representation of market action. 2. For forecasting, once a particular price or market action is identified, the practitioner may now use this information to interpret what the data actually means before inferring future price action. 1.3 Forecasting price and market action. There are three main approaches to predicting potential future price action or behavior, namely via 1. Fundamental analysis. 2. Technical analysis. 3. Information analysis. Forecasting stock prices using fundamental analysis. One way to gauge the potential price of a stock is by analyzing the company's performance via its financial statements and accounts in order to determine its intrinsic value. The price of a stock The price of a stock is expected to rise if there are sufficient buyers, signifying a demand for it. Conversely, the price of a stock is expected to decline if there are sufficient sellers, signifying an oversupply in the stock. Demand is potentially generated if the current stock price is below its estimated intrinsic. Demand is potentially generated if the current stock price is below its estimated intrinsic. There are various ways to determine the degree of over or undervaluation in a stock, some of which include comparing P/E and earnings per share, (EPS) ratios, or investigating to what extent a stock is trading at a premium or discount in relation to its net current asset value, debt, and other Fundamental analysis helps provide indications as to which stocks to buy based on prior company performance, that is, over the last accounting period. Some investors resort to more active asset allocation methods to try to time the market for a suitable stock to buy into or get out of rather than just relying on the traditional buy and hold strategy. They resort to studying broad market factors and sector rotation models in order to buy into the best fundamentally performing stocks within a strengthening industry or sector. This method is popularly termed the top-down approach to investing. A bottom-up approach relies more on a specific company's fundamental performance. A buy and hold strategy in today's volatile markets may not represent the most effective way of maximizing returns while minimizing potential risks. As a result, many fundamentalists frequently look to various asset pricing and modern portfolio models like the capital asset pricing model and between risk and expected returns over a risk-free rate along what is called the efficient frontier. CAPM to try to achieve the best bull. One of the problems with fundamental analysis is the credibility, reliability, and accuracy of the accounting practices and financial reporting, which is susceptible to manipulation and false or fraudulent reporting. Decisions, as opposed to short-term market participation, where short-term price fluctuations and precise market timing may be of lesser importance. Fundamental data, on a broader scale, accounts for the overall underlying economic performance of the markets. It is not just the calculated or estimated intrinsic value that is an important element but also the general perception or future expectation of this value that plays an arguably greater and more significant role in determining the actual share price of a stock. Forecasting stock prices using information. Generally, information may be gleaned from various public sources such as newspaper reports, magazines, online bulletins, and so on, upon which market participants may then formulate an opinion about the market, making their own predictions about potential market action. Unfortunately, such publicly available information usually has little merit when used for forecasting purposes, as those more privy to non-public material information would have already moved the markets substantially, leaving only an inconsequential amount of action for latecomers to profit from, at the very most. This is where technical analysts have the unfair advantage of observing the markets moving on the charts and immediately taking action, regardless of the cause or reasons why such action exists. Forecasting stock prices using technical analysis. Technical analysis is essentially the identification and forecasting of potential market behavior based largely on the action and dynamics of the market itself. The action and dynamics of the market is best captured via price, volume, and open interest action. Technical analysis is the science of recording, usually in graphic form, the history of trading. Then deducing from that pictured history the actual probable future trend. Edwards and McGee, Technical Analysis of Stock Trends, AMACOM, 2007. Technical analysis is often criticized for the use of past information as a basis for forecasting future price action, relying on the notion that certain price behaviors tend to repeat. The following definition of technical analysis tells us that it is the study of pure market action and not the fundamentals of the instrument itself. It refers to the study of the action of the market itself as opposed to the study of the goods in which the market deals. Edwards and McGee, Technical Analysis of Stock Trends, AMACOM, 2007. The art of technical analysis, for it is an art, is to identify a trend reversal at a relatively early stage and ride on that trend until the weight of the evidence shows or proves that the trend has reversed. Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. The following definition is most relevant in the formulation of trading strategies. It reminds the market participants that nothing is certain and we must weigh our risk and returns. Technical analysis deals in probabilities, never in certainties. Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. Technical analysis is based on the assumption that people will continue to make the same mistakes they have made in Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. The past. This definition by Pring stresses and underscores the point that there is a real reason and explanation as to why past price patterns tend to repeat. Fundamental versus technically based market timing. Before proceeding any further, it is best to briefly explain the meaning of a few commonly used terms in trading and technical analysis. To go long means to buy to open a new position. To liquidate means to sell to close a position previously held. To go short means to sell to open a new position. To cover means to buy to close a position previously shorted. Both fundamental and technically based market timing aim to satisfy the same basic principle of buying low and selling high. There are 4 basic scenarios where this may occur. 1. Long at a low price and liquidate at a higher price. 2. Long at a relatively high price and liquidate at an even higher price. 3. Short at a high price and cover at a lower price. 4. Short at a relatively low price and cover at an even lower price. Technically based market timing offers the ability to provide precise entry and exit prices. Provide the precise time of entry and exit. Equals provide real-time bullish and bearish signals. Provide real-time entry and exit price triggers. Scale in and out based on significant price levels, time entries and exits based on volatility behavior of the underlying. Dash. Exit extended trends at technically significant price reversal levels. Time entries and exits based on market order flow price levels. Define percent risk in terms of significant. Use volume and open interest analysis to gauge strength of an underlying movies in order to time entries and exits. Use market breadth and broad market sentiment to gauge the strength of an underlying movies in order to time entries and exits. Forecast potential peaks for shorting or liquidating positions, as well as potential troughs for getting long and covering positions via the use of cycle and seasonality analysis. Fundamentally based market timing offers the ability to gauge undervalued stocks with the potential to appreciate in value, but lacking information regarding the precise price or time to get long or to cover. Gauge overvalued stocks with the risk of depreciating in value, but lacking information regarding the precise price or time to get short or to liquidate. Screen and participate in fundamentally strong stocks in a sector or industry as part of an active asset allocation or rotation strategy, but lacking information regarding the precise price or time to get long. The fundamentalist versus technical analysts. Listed below are some characteristics of the fundamentalist and technical analyst. The fundamentalist is mainly concerned with intrinsic value, strives to understand the underlying causes for potential market moves, is focused on which company to participate in, can tell you which company to invest in, but cannot tell you the most advan in that stock. Tejas moment to start participating. The technical analyst is mainly concerned with structure and dynamics of market and price action. Is more concerned with the effects of potential market moves rather than the cause of them. Technical data and information. Technical analysts study market action. Market action itself is mainly comprised of the study of price action, volume action, open interest action, sentiment, market breadth, flow of funds. 1.4 Classifying technical analysis. Pay here to search. Technical analysis may be categorized statistical, sentiment, and behavioral analysis. Regardless of which branch is employed, all analysis is eventually interpreted via the various behavioral traits, filters, and biases unique to cash analyst. Behavioral traits include both the PSY psychological and emotional elements. Sec figure 1.6. Into 4 distinct branches, that is, classy. Classical technical analysis involves the use of the conventional bar chart and Japanese candlestick patterns, oscillator and overlay indicators, as well as market breadth, relative strength, and cycle analysis. Statistical analysis is more quantitative as opposed to the more qualitative nature of classical technical analysis. It studies the dispersion, central tendencies, skewness, volatility. It studies the dispersion, central tendencies, skewness, volatility, regression analysis, hypothesis testing, correlation, covariance, and so on. Sentiment analysis is concerned with the psychology of market participants, which includes their emotions and level of optimism or pessimism in the markets. It studies professional and public opinion via polls and questionnaires, trading and investment decisions via flow of funds in the markets, as well as the positions taken by large institutions and hedgers. Finally, behavioral analysis studies the way market participants react to news, profit and losses, the actions of other market participants, and with their own psychological and emotional biases, preferences, and expectations. Mean reverting versus non-mean reverting approach. The type of technical studies employed also depends on the approach taken by traders and analysts with respect to their personal preferences and biases regarding the action of price in the markets. Basically, traders either adopt a contrarian or a momentum-seeking type approach. In essence, they expect price to be more mean reverting, returning to an average price or balance. In essence, they expect price to be more mean reverting, returning to an average price or balance between supply and demand. They expect price to be more non-mean reverting, where demand creates further demand and supply creates further supply, both driven by a powerful positive feedback cycle. It is applicable across all markets, instruments, and time frames, where price patterns, oscillators, and overlay indicators are all treated in exactly the same manner. No new learning is required in order to trade new markets or time. There is no need to study the fundamentals of the markets traded or analyzed. Technical analysis provides a clear visual representation of the behavior of the markets. It provides timely and precise entry and exit price levels, preceded by technical signals indicating potential bullishness or bearishness. It makes the gauging of market risk much easier to visualize. The concerted effort of market participants acting on significantly clear and obvious price triggers in the markets helps create the reaction required for a more reliable trade. It is subjective in its interpretation. A certain price pattern may be perceived in numerous ways. Unfortunately, all manners of interpretation, regardless of the underlying analysis employed, fundamental, statistical, or behavioral, are equally subjective in content and form. A basic assumption of technical analysis is that price behavior tends to repeat, making it possible to forecast potential future price action. Charts provide a historical record of price action. It takes practice and experience to be able to identify classical patterns in price. The strong form of the efficient market hypothesis, EMH, argues that since the markets discount all information, price would have already adjusted to the new information and any attempt to profit from such information would be futile. The next chart, figure The next chart, figure 1.10, shows the application of basic trendline analysis on the same chart, tracking the flow of price action in the market. In figure 1.11, moving average analysis is now employed to track the same flow of price action and to provide potential points of entry as the market rises and falls. Figure 1.12 depicts the application of chart pattern analysis to track and forecast the shorter-term bullish and bearish movements in price. Figure 1.13 is an example of applying two forms of technical analysis, that is, linear regression analysis and divergence analysis, to track and forecast potential market tops and bottoms. Notice that the market top coincided perfectly with the upper band of the linear regression line, with an early bearish signal seen in the form of standard bearish divergence on the commodity channel index key indicator. Figure 1.14 is an example of applying a couple of additional forms of analysis to the basic linear regression band. In figure 1.15, volatility band, volume, and overextension analysis are all employed to seek out potential reversals in the market. We observe that price exceeds the upper volatility band, which may potentially be an early indication of price exhaustion, especially since it is accompanied by a significant volume spike. The moving average convergence divergence (MACD) indicator is also seen to be recede at historically overbought levels, which is another potentially bearish indication. As we can see from just a few forms of analysis presented in the preceding charts, there are many ways to view the action of the markets, depending on the context of the analysis employed. Tick volume tracks the number of transactions over a specified time interval, irrespective of the size of the transactions. Subjectivity in pattern identification. As mentioned, interpretation and inference of potential future price action based on historical price behavior is essentially an exercise in subjectivity. The ascending triangle is regarded as a bullish indication, while the complex head and shoulders formation is potentially bearish. Therefore, as price starts to contract, forming a symmetrical triangle, an analyst may be somewhat perplexed at the conflicting signals, being unable to provide a clear forecast as to whether the market is indeed potentially bullish or bearish. The sentiment associated with larger patterns or formations will take precedence over that of smaller formations. The smaller formations act as additional evidence and add to the overall bearish sentiment. Subjectivity and selective perception. Human bias is another factor that adds to the degree of subjectivity when attempting to interpret technical signals. Chartists will many times ignore signals that conflict with their preconceived ideas of where the markets ought to be at any one time. They only select oscillators and indicator signals that support their analysis of the market. For example, a chartist uses three oscillators, the MACD, Relative Strength Index, RSI, and stochastics. The chartist has a bullish view of the markets and believes that it is about to break to the upside. All of the oscillators have bullish readings except for stochastics. The chartist ignores the stochastics signal because it does not agree with his or her view of the markets. On a subsequent occasion, it is MACD that is not in agreement with the chartist's view, and only the signals from the other two oscillators are heeded. This is known as selective perception. See Figure 1.19. Selective perception adds to the subjectivity of the forecast, as there is no fixed point of reference or basis for making decisions based on evidence. Choosing only signals that agree with one's view will lead to biased and erroneous interpretations and unfounded forecasts. In fact, it is when there are discrepancies in the signals that the chartist gains the most information from the markets, as it may be an indication that there could well be some form of underlying weakness in the markets. Subjectivity in determining an event, the point of entry. Identifying, interpreting, and inferring market subjectivity plays a significant role. The determination of the exact points of entry, action, are not the only areas where to an exit from the market is also subjective at the most fundamental level of observation. What appears to be essentially objective is also built on a foundation of subjectivity. An example will help illustrate the point. The first selective perception adds to the subjectivity of the forecast, as there is no fixed. See Figure 1.19. Selective perception adds to the subjectivity of the forecast, as there is no fixed point of reference or basis for making decisions based on evidence. Choosing only signals that agree with one's view will lead to biased and erroneous interpretations and unfounded forecasts. In fact, it is when there are discrepancies in the signals that the chartist gains the most information from the markets, as it may be an indication that there could well be some form of underlying weakness in the markets. Subjectivity in determining an event, the point of entry. Identifying, interpreting, and inferring market subjectivity plays a significant role. The determination of the exact points of entry, action, are not the only areas where to an exit from the market is also subjective at the most fundamental level of observation. What appears to be essentially objective is also built on a foundation of subjectivity. Assumptions of technical analysis. Technical analysis is based on a few fundamental assumptions. The first assumption is that market action, which includes price action, reflects all known information in the markets. The market discounts everything except acts of God. This means that the markets can only discount known information. Expectations about known information, expectations about potential events. The market cannot discount unexpected events, unknown information. What are the markets really discounting? It is not merely news, economic releases, or corporate data that the markets are discounting. The assumption is that it discounts everything. This includes information about actual events, expectation about actual events, information about expected events, expectation about expected events, expectation about the possibility of unexpected events. Market discounting versus EMH. Efficient market hypothesis. EMH states that for a market to efficiently discount and reflect all information perfectly, all of its participants must act on all information in the same rational manner instantaneously. Sum total of all actions taken by its participants, be it in a timely or untimely, rational or irrational fashion. The weak form of EMH suggests that all current prices have already sum total of all actions taken by its participants, be it in a timely or untimely, rational or irrational fashion. The weak form of EMH suggests that all current prices have already been fully discounted and, as such, reflect all past price information. 2. The semi-strong form of EMH. The semi-strong form of EMH suggests that all information, once public, is of little use as price would have already adjusted to the new information, making the use of such information unprofitable and pointless. 3. The strong form of EMH suggests that all information, regardless of whether public or private, would have been already fully reflected in the current price. Random. Closely related to the EMH is the concept of random walk. Random walk suggests that prices move in a purely random manner and that past prices do not have any influence on current price. Current price has no influence on future price. Markovian condition. Market behavior repeats itself. The second assumption or premise of technical market behavior repeats itself. The second assumption or premise of technical analysis is that market behavior has a tendency to repeat itself. The uses of past patterns to predict future moves are grounded in the reliability and consistency of human behavior. Although trend following is popular, there are some challenges to using it, some of which are inefficient trade sizing in volatile markets, inefficient profit capture during trends, inefficient performance in ranging markets, inefficient adaptation to more volatile trend action, inability to identify trend changes efficiently, possibility of negative slippage in fast-moving markets, possibility of large drawdowns due to the low winning percentage, reduced performance caused by whipsaw action during consolidation, ineffective influx of trend capturing systems produces inefficient fills back and forward testing. Finally, it is important to note that a trend in one time frame may be a sideways market in another. The fourth premise is specifically about the effects of the self-fulfilling prophecy. It is easy to understand why a largely concerted wave of buying or selling at various points on a price chart may cause a significant reaction in price. This concerted wave of buying or selling will generally be more pronounced if these points are significantly clear and obvious to most market participants using technical analysis. Hence, we generally notice a larger than average penetration bar during trendline breakouts, especially if the trendline is significantly clear and obvious to most traders. This also implies that should an indicator be essentially faulty or illogical in its design, if enough participants risk actual capital based on signals, it would begin to exhibit a greater level of reliability. The efficacy of technical analysis at various timeframes. Technical analysis generally works more efficiently at timeframes where there are fewer forms of analyses available. For example, on higher timeframes like the daily, weekly, monthly, or yearly charts, fundamental analysis plays a very important role in helping to forecast potential market action. But at very low timeframes like the 1-minute charts, fundamental analysis may not be as useful, especially if the stop size is very small. In essence, the smaller the stop size, the more important will be the role of applying technical analysis when trying to forecast very short-term price. This is the main reason why technical analysis is generally movements in more reliable at lower time frames. We can categorize them by the amount of time they spend in the markets or by the methodology that they employ when trading or investing in the markets. Popular markets and instruments. Market participants may trade and invest in either Popular markets and instruments. Market participants may trade and invest in either the main markets or instruments that allow access to these markets. These instruments are also referred to as derivatives, since they are derived from the main underlying markets. For example, a market participant may participate in gold in several ways. By buying the physical gold itself, main market; by buying or selling a futures contract on gold, derivative; by buying or selling an options contract on gold, derivative; by investing in gold-backed ETF shares, derivative; by investing in trading gold via contracts for difference, CFD, derivative. Chapter 2. Introduction to Dow Theory. 2.1 Origins and Proponents of Dow Theory. Charles H. Dow is credited for much of the early work that led to what is known today as Dow Theory. 2.2 Basic Assumptions of Dow Theory. There are 6 basic tenets of Dow Theory, namely: 1. The averages discount everything. 2. The market has 3 trends. 3. Primary trends have 3 phases. 4. A trend persists until its reversal is indicated. 5. The averages must confirm one another. 6. Volume must confirm the trend. In addition to the 6 basic tenets, only closing prices are recognized in Dow Theory. The averages discount everything. Pricing in information. It is believed that the market discounts everything, except acts of God. This means that the market is the end result of all participatory action, which represents all information that may be known to the markets. The mechanism by which information is known to the market is that of actual participation via capital injection. Figure 2.2 shows the gold market adjusting very rapidly to information about the same event. Price is the ultimate reflection and embodiment. Figure 2.2 shows the gold market adjusting very rapidly to information about the same event. Price is the ultimate reflection and embodiment of everything that is knowable. The market has 3 trends. The Handbook of Technical Analysis. The second assumption of Dow Theory is that the market The Handbook of Technical Analysis. The second assumption of Dow Theory is that the market comprises 3 trends. Robert Rear explains, in his book The Dow Theory, there are 3 movements of the averages, all of which may be in progress at one and the same time. The first, and the most important, is the primary trend, the broad upward and downward movement known as bull or bear market, which may be of several years' duration. The second and most deceptive movement is the secondary reaction, an important decline in a primary bull market or a rally in a primary bear market. The reactions usually last for 3 weeks to as many months. The third and usually an important movement is the daily fluctuation. Summarizing, the market is believed to express itself as three distinct trends, namely 1. Primary trend, major trend, lasting from months to years, long term. 2. Secondary reaction, intermediate trend, lasting from weeks to months, medium term. 3. Minor trend lasting for days to weeks, short term. See figure 2.3. 1. The primary trend. The largest trend is by far the primary trend, which is normally expected to last from months to years. There are two types of primary trends, namely 1. Primary bull trend, bull market. 2. Primary bear trend, bear market. In Dow theory, an uptrend is defined primarily as successively higher peaks and troughs. According to Dow, it is more important to participate in a primary bull or bear trend once it has been confirmed or once it proves that it has the strength to penetrate old peaks or troughs. The secondary reaction usually retraces from 1 to 2/3 of the primary trend range. Any retracement volume usually signifies that the correction beyond 2/3 on high secondary reaction may in fact be a new primary bear market. The minor trend. The minor trends are not regarded as important in Dow theory. In fact, Hamilton commented in his book The Stock Market Barometer that the stock market is not logical in its movements from day to day. Lines are simply narrow horizontal ranging formations on a daily chart. They are usually formed in anticipation of some significant news or economic announcement. These narrow consolidations usually result in strong breakouts. Dow theory recognizes lines as potentially profitable formations even though they are essentially regarded as minor trends. Primary trends have three phases. Primary or major trends have three phases. A primary bull or bear market consists of the following three phases. 1. Accumulation phase. 2. Trending phase. 3. Distribution phase. Accumulation normally occurs after a lowing company releases very negative data. The uninformed market participants are usually extremely bearish at this point, selling off whatever shares they have left at any price available. The accumulation phase normally lasts longer than the distribution phase due to less capital and profit at risk. Deep and rapid decline in prices fall. The trend phase consists of the uptrend and downtrend phase. The uptrend phase is driven by market participants expecting higher prices after an accumulation. The uptrend phase tends to last longer than the downtrend phase due to less capital and unrealized profit at risk at lower prices. The downtrend phase normally starts to accelerate as more companies start to report increasingly bearish news. A trend persists until its reversal is indicated. In Dow theory, a trend is assumed to persist until there is evidence to the contrary. Trend changes are identified by a penetration of a previous significant peak or trough. 1. Failures. 1. Failure swings. 2. Non-failure swing. Double tops bottoms. The term failure swing was first used by Wells Wilder in his book New Concepts in Technical Trading Systems, when describing the oscillator swings on the Relative Strength Index (RSI) indicator. The averages must confirm one another in Dow theory. The averages must confirm one another in Dow theory. There is a requirement that both the industrial's average and the railroad average must extend beyond their secondary peaks in order for a trend to be established, that is, the trend in on average must be formed by the other. Average. In figure 2.20, we observe that the In figure 2, average. In figure 2.20, we observe that the industrial average penetration its secondary The averages must confirm one another in Dow theory. There is a requirement that both the industrial's average and the railroad average must extend beyond their secondary peaks in order for a trend to be established, that is, the trend in on average must be formed by the other. Average. In figure 2.20, we observe that the industrial average penetration its secondary peak at T1 while the railroad average penetration its own secondary peak a little later at T2. Hence the uptrend was only confirmed at time T2. As far as Dow theory is concerned, the uptrend was not confirmed until the railroad average penetration its own secondary peak at T2. In figure 2.22, we observe that the Dow Jones Industrial Average experienced a weak non-failure swing sell signal, signifying a change in the trend. Volume must confirm the trend. Expanding in the direction of the existing trend means that Expanding in the direction of the existing trend means that 1. In an uptrend, volume should be increasing. 2. In an uptrend, volume should be decreasing during a downside retracement. 3. In a downtrend, volume should be increasing. 4. In a downtrend, volume should be decreasing during an upside retracement. Is not met, the existing trend may be, if any of the four conditions listed above, potentially weaker than expected and may lead to a reversal in the existing trend. In figure 2.25, we see volume in area A on the chart expanding in the direction of the existing primary bull trend in gold. Only closing prices are recognized. In Dow theory, only closing prices are recognized. This means that regardless of how large the high and low price excursions may be on any one day, only the final closing price will be used. 2.3 Challenges to Dow theory. There are many criticisms of Dow theory. Here are some of the more significant arguments against it. 1. Dow theory is more applicable to the equity markets. Detractors of Dow theory argue that the theory is unsuitable for application in faster moving markets or across lower time frames. Monetary policy such as near zero interest rates set by central banks over extended periods combined with colossal stimulus packages and quantitative easing K to infinity type operations impact the longer term action of the markets by creating an artificially super bullish environment where even its participants have little or no fear of anything untoward happening to the markets. 4. Only closing prices are recognized. Recognizing only the closing prices notes potentially large intraday ranges that may occur during the day's trading session. 5. The buy and sell signals based on the primary trend are safer. This may or may not be true, but detractors of Dow theory argue that such signals usually occur late in the trend and miss a large part of it. Underperformance in either the industrial or transportation average leading to non-confirmation would logically signal potential trouble in the economy. Unfortunately, the Dow Jones Industrial Average today is composed of many stocks that do not produce any physical product that requires shipping or transport in general. Many of today's companies are more involved in financial products, telecommunica. 2.4 Chapter Summary. As we have seen, Dow theory forms the basis for much of technical analysis in the 21st century. Chapter 3. Mechanics and Dynamics of Charting. Traditional charting is a two-dimensional matrix upon which technical data or information is viewed. These quantitative analysts and statisticians employ various forms of time series and stochastic analysis and conduct back and forward testing on technical data. Technical data. Some of the more common technical data or information employed to construct charts include price data, open O, high H, low L, close C. Transaction related data, volume V, open interest, opening parenthesis or I closing parenthesis. Market breadth data, advances A, decline D, total issues 1, up volume, down volume, UV, TV, new highs, new lows, NH, NL, bullish percent data, sentiment data, put call ratio, short interest ratio, specialist public ratio, cash asset investor and advisor poll data, margin debt, implied volatility, VIX, quantization of price, created. In order to create OHLC data, we first need to specify the time interval over which price activity occurs. For example, let us assume that we are interested in identifying the opening, high, low, and closing prices over 5-minute intervals. We therefore need to separate or quantize price activity with respect to time for each successive 5-minute interval or period. An interval or period may be of any duration, but the most popular intervals are 1 min, 5 min, 15 min, 1 hour, 4 hour, daily, weekly, monthly, and yearly. In our example, the price at the beginning and end of any 5-minute interval represents the opening O and closing C price respectively, while the highest and lowest price within that period represents the high H and low L prices. In most cases, the closing price will also represent the opening price of the next 5-minute interval unless there is a gap in price. Figure 3.1 depicts price activity within a 5-minute period. Price is quantized into 5-minute intervals and is summarized into 4 pieces of information, namely the OHLC data. Note that OHLC data is also used to construct other representations of price activity like bar charts, Gann bars, and Japanese candlesticks. The range of a bar or candlestick is simply the absolute difference between the high and low price, that is, range in LI. G. 1. Refer to figure 3.2. To create OHLC data for bars and candlesticks over long periods, simply identify the opening price of the first period O2, closing price of the last period C. 3. Highest price between the opening and closing price H. 4. Lowest price between the opening and closing price L. Autoscaling attempts to fill the entire Autoscaling attempts to fill the entire screen with price activity. As such, the heights of bars and candlesticks constantly change, depending on whether price is ranging or trending. If prices are flat or ranging, it will expand all price activity and attempt to stretch it across the entire screen, making low volatility activity seem more volatile by increasing the height of all the bars and candlesticks on the screen. Conversely, when prices are trending, autoscaling will shorten the height of all bars on the switching of the autoscaling function normalizes volatility on the charts, allowing for more accurate price visualization. Refer. Four. Lowest price between the opening and closing price L. Autoscaling attempts to fill the entire screen with price activity. As such, the heights of bars and candlesticks constantly change, depending on whether price is ranging or trending. If prices are flat or ranging, it will expand all price activity and attempt to stretch it across the entire screen, making low volatility activity seem more volatile by increasing the height of all the bars and candlesticks on the screen. Conversely, when prices are trending, autoscaling will shorten the height of all bars on the Switching off the auto-scaling function normalizes volatility on the charts, allowing for more accurate price visualization. Referring to the top two charts in figure 3.6, we observe a certain region of price activity encircled, being portrayed as more volatile than it really is by virtue of increasing the height of all its bars when prices across the screen are ranging or flattish. Significance of OHLC data. The highs and lows represent areas of price rejection caused by the responsive actions of market participants. The durations between active trading sessions are longer. The opening and closing prices are created over a longer interval, i.e., belonging to a higher timeframe bar or candlestick. Single quote. In markets where the trading is continuous, opening and closing prices have lesser importance as compared to high and low prices, as in the case of the spot foreign exchange (FX) market, which trades continuously through the week from Sunday evening to the Friday close. 3.2 Gap action. 4 types of gaps. There are essentially 4 ways to define a gap, which is represented by a range of prices where no trading activity takes place. Type 1, a gap measured from the close of the previous bar to the open of the next or current bar. It is created instantaneously at the open. There is an instant jump in prices either up or down, with no trading activity taking place between the two prices. Type 2, a gap measured from the high or low of the previous bar to the open of the next or current bar. It is created instantaneously at the open. Type 3, a gap measured from the highs or lows of the previous bar to the highs or lows of the next or current bar. It is created only after the next or current bar has closed. Type 4, a gap measured from the close of the previous bar to the high or low of the next bar. It is created after the next or current bar has closed. See figure 3.9. It should be noted that of support or resistance, depending on whether price is above or below it. This is especially so when the gap created is a type 3 gap. The gap or price window increases in significance and importance with larger gaps. Prices are also generally expected to return to fill the gap at a later date, although there are many instances where this does not occur. Finally, it may be of interest to the reader to know that the average true range (ATR) is somewhat related to a type 4 gap, where the true range is either the range of the new bar or distance between the close of the last bar and the high or low of the new bar, depending on whichever is greater. 3.3 Constant chart measures. There are 5 types of constant measure charts, namely: There are 5 types of constant measure charts, namely: 1. Constant time charts. Bar closes when a specified time interval is met, for example, candlestick charts, bar charts, equivalent charts. 2. Constant range charts. Bar closes when a specified excursion in price is met, for example, point and figure charts and Renko charts. 3. Constant volume charts. Bar closes when a specified volume is met. 4. Constant transaction tick charts. Bar closes when a specified number of transactions, trades, is met. 5. Constant volatility charts. Bar closes when a specified amount of standard deviation or ATR is met. Constant time charts. Constant time charts quantize price activity into units of time, or intervals. Each bar is complete once a specified amount of time has elapsed. The bar range is variable. The bar duration is constant. Examples of constant time charts include Japanese candlestick, bar, equivalent, and line charts. Constant time charts represent the most popular form of chart construction. Bar charts as seen in figure 3.1. A bar chart is easily created via the quantization of price into specified time intervals or periods. Line charts. Time interval line charts are created by connecting all of the closing prices. Each closing price. Japanese candlestick charts. Japanese candlesticks are created in essentially the same manner as standard price bars, as seen in figures 3.1 to 3.3. The only difference is that the space between the opening and closing price is boxed up and is referred to as the real body. Equivalent charts. Equivalent charts are based on constant time-based bars, incorporating volume over a specified time interval. Constant range point charts. Charts. Axial increments on. On constant range charts, each bar, box, or brick is complete once a specified excursion in price is met. The bar or box range constant. The bar or box duration is variable. The bar or box volume is variable. The transactions per bar is variable. The bar or box volatility is constant. Point and figure charts. Point and figure charts represent the most popular form of constant range charting. Renko charts. Renko charts are another form of constant range charting. The Renko bars are referred to as bricks. There are bullish white bricks and bearish black bricks. They are very similar to point and figure charting except that each new brick is plotted in a new column. A new brick is plotted once the minimum price excursion required for a new brick to be created is met. Since the creation of a new brick is not time dependent, the time axis as all reversals require price to move at least 2 bricks in the opposite direction. The plotted in a nonlinear fashion. Hence, Renko charts are essentially 2 brick reversal charts. Again, the size of brick is arbitrarily chosen. In linear scaling, equal distances on the In linear scaling, equal distances on the chart represent equal price changes. This would imply that equal price changes at higher prices would result in lower percentage changes. For example, a price change from $10 to $20 would represent a $10 change in price and a 100% change in price, that is, $20 $10, $10 by 100%. A price change from $90 to $100 would also represent a change of $10 in price, but at this higher price level, its percentage change is merely $100 $90, $7.90 by 100% equals 11.1% chance. For linear scaling, the percentage change is not preserved for equal units of price change. If P represents the north price, then linear scaling simply means that P's is a constant for every equal distance move on the chart. See figure 3.16. In ratio scaling, equal distances on the chart represent equal price percentage changes. If P represents the north price, then ratio scaling simply means that Pn equals Pn per peta-Newton minus 1 is a constant for every equal distance move on the chart. Figures 3.17 and 3.18 how the percentage increments need to rise to account for an equal price show change. This formula represents what is also referred to as stock returns. Linka scaling provides better upper end definition and visualization of prices, but relatively poorer clarity at lower prices. Ratio scaling provides better lower end definition and visualization of prices, but relatively poorer clarity at higher prices. It also does not affect overlay indicators that indicate horizontal levels of support and resistance, like prior support and resistance levels, Fibonacci extension, retracement, projections, and expansions. GAN 1/8 and 1/3 price retracement. GAN square of 9 price projections. It will indicate an uptrend line penetration that is later than that for ratio scaling but earlier than an uptrend line penetration based on a linear scale. Uptrend lines are penetrated sooner while downtrend lines are penetrated lower on ratio or logarithmically scaled charts. Uptrend lines are penetrated later while downtrend lines are penetrated sooner on linear or arithmetically scaled charts. The bid-based chart and bid-ask spread charts are typically drawn based on bid prices, although many charting platforms also allow for the display of price action based on ask and mid prices. It is also dependent on whether we are buying at the ask, buying at the bid, selling at the ask, selling at the bid. Chapter 4. Market Phase Analysis. 4.1 Dow Theory of Market Phase. As we have learned from Dow theory in Chapter 2, a primary bull or bear trend consists of 3 phases, specifically 1. Accumulation phase, 2. Trending phase, 3. Distribution phase. According to Dow theory, a primary trend typically spans from months to years in the equity markets. Due to the high leverage that is afforded traders in the futures markets, primary trends in the commodity futures markets tend to span relatively shorter durations. High leverage tends to induce greater volatility in the markets. The consolidation phase may be further subdivided into the accumulation and distribution phases. See figure 4.1. Whether consolidation represents accumulation or distribution is only ascertained after the fact. That is, if the market rises after consolidating, we say that the consolidation represents accumulation, buying activity. Conversely, if the market declines after consolidating, we say that the consolidation represents distribution, selling activity. Market phase sentiment and participatory behavior. The psychological and participatory aspects associated with each market phase are briefly described as follows. Accumulation phase. Accumulation normally occurs after a deep Accumulation phase. Accumulation normally occurs after a deep and rapid decline in prices available. It is at this point that the informed or smart market participants start accumulating shares at extremely advantageous prices. This contrarian approach by the informed participants helps create a final and decisive bottom in the market with very large responsive buying by the smart investors during the last stages of the preceding downtrend in the form of a sell or forth selling climax. Smart investors normally have deep pockets in order to engage in such contrarian-based participation. The accumulation phase normally lasts relatively longer than the distribution phase. Trend phase. The uptrend phase is normally fueled by traders and investors expecting either higher prices after an accumulation or lower prices after a distribution. The uptrend phase tends to be more prolonged than the downtrend phase, due to the lower amounts of capital at risk at the lower, more affordable prices. The downtrend phase begins with a breakdown in prices from a distribution range with increasingly bearish fundamental data reported by companies. As prices descend, the uninformed traders and investors begin to unload some positions. Bearish sentiment continues to intensify as prices sink to new depths. Distribution phase. Distribution normally occurs after a strong and rapid rise in prices. Companies tend to outperform with the release of very positive data, accompanied by the most bullish media headlines and news. The distribution phase normally lasts a relatively shorter time than the accumulation phase. This is due to the larger amount of capital and unrealized profit at risk at higher prices at the top of the market. Technical aspects of consolidations. Accumulation tends to have the following characteristics. It generally occurs at the end of a relatively rapid decline in prices and ideally in the proximity of a historical or significant prior bottom in the market. There is no evidence of lower troughs being formed. It represents the start of either a new primary bull market on a longer term horizon or a new shorter term uptrend if based on lower time frames. Accumulations tend to last longer than distributions. Volume begins to subside as a potential upside breakout approaches. The longer the accumulation process, the more powerful the subsequent breakout will be to either side of the range, typically accompanied by a surge in volume. Accumulations tend to experience lower volatility in contrast to distributions, due to the lower prices and consequently lower capital at risk. Distribution tends to have the following characteristics. It generally occurs at the end of a prolonged uptrend in prices and ideally in the proximity of a historical or significant prior top in the market. There is no evidence of higher peaks being formed. It represents the start of either a new primary bear market on a longer term horizon or a new shorter term downtrend if based on lower time frames. Distributions tend to experience much greater volatility in contrast to accumulation, due to the higher prices and consequently greater capital and unrealized Profit at risk. Completion of a consolidation phase. There is no absolute completion of a consolidation phase. There is no absolute consensus or measure to determine the exact point in time or price at which a consolidation ends. It really depends on the approach and objectives of the trader or analyst. Logically, once a consolidation is complete, it also implies that a trend may already be in effect. 4.2 Chart Pattern Interpretation of Market Phase. Market phase can also be potentially identified by the type of chart patterns that manifest themselves at each stage of the three phases. Both the accumulation and distribution phases tend to be populated by reversal patterns. Interestingly, the majority of reversal and continuation chart patterns are usually also regarded as consolidation patterns. Unfolds within a relatively confined and well-defined price range. Lacks any significant trend component. Although V-tops and V-bottoms are reversal patterns that occur more frequently during distributions than accumulations. Chart patterns have both intrinsic and extrinsic bullish and bearish bias. Extrinsic bias may also be referred to as location-based sentiment. Intrinsic bias is the inherent bullish or bearish sentiment associated with a chart pattern that is independent of location and where sentiment is strictly based on the nature of the pattern. For example, an ascending triangle is intrinsically bullish, that is, it has a bullish bias, regardless of where this pattern occurs with respect to past price action. It will always be inherently a bullish indication. If this bullish pattern is found at the price level of some historically significant market top, we say that it is extrinsically bearish, that is, the pattern is located at a significant resistance. Some chart patterns, like symmetrical triangles and horizontal channels, are essentially intrinsically neutral chart patterns with no obvious bias in sentiment. Some authors and practitioners classify them as continuation patterns, whereas others refer to them as reversal patterns. Direction of the preceding trend. Location with respect to historical extremes in price. Location with respect to the phase of an underlying market cycle. Location with respect to other supportive and resistive overlay barriers to price. Bullish or bearish divergent formations. Intrinsically bullish patterns. Bullish pennants. Bullish flags. Ascending triangles. Inverted head and shoulders. Rounding bottoms. Cup and handles. Falling wedges. Double, triple, and multiple bottoms. Intrinsically bearish patterns. Bearish pennants. Bearish flags. Descending triangles. Standard head and shoulders. Rounding tops. Rising wedges. Double, triple, and multiple tops. Intrinsically neutral patterns. Symmetrical triangles. Horizontal channels. Intrinsically bullish patterns with respect to trend sentiment. Bullish pennants occurring in an uptrend. Bullish flags occurring in an uptrend. Ascending triangles occurring in an uptrend. Inverted head and shoulders occurring in an uptrend. Rounding bottoms occurring in an uptrend. Cup and handles occurring in an uptrend. Falling wedges occurring in an uptrend. Symmetrical triangles occurring in an uptrend. Horizontal channels occurring in an uptrend. Broadening formations occurring in an uptrend. Intrinsically bearish patterns with respect to trend sentiment. Bearish pennants occurring in a downtrend. Bearish flags occurring in a downtrend. Descending triangles occurring in a downtrend. Standard head and shoulders occurring in a downtrend. Rising wedges occurring in a downtrend. Symmetrical triangles. Symmetrical triangles occurring in a downtrend. Horizontal channels occurring in a downtrend. Broadening formations occurring in a downtrend. In figure 4.10 we observe a bear flag formation triangle. In figure 4.10 we observe a bear flag formation triangle as continuation within a trend phase. Nevertheless, as far as the trader is concerned, failed patterns oftentimes lead to a more powerful reaction and consequently a more profitable venture. In technical analysis, the element of surprise or of the unexpected should never be underestimated. In In figure 4.12 we observe a symmetrical triangle acting as accumulation within a larger consolidation zone on the daily chart of gold. In proximity also lies additional barrier support in the form of a downtrend line. Volume tends to decline to volume tends to decline to relatively low levels just prior to a phase transition. Should an uptrend or downtrend be inherently weak, then this is normally indicated by a fall off in volume during the trend phase. If open interest increases during a increases during a consolidation instead of decreasing, the breakout move in subsequent trend tends to be much more rapid and extended. The trend phase then ensues with bullish volume divergence and subsequently transits into an accumulation phase. Single quote. 4.4 4.4 Moving average interpretation of market phase. Market phase can also be potentially identified by the behavior of moving averages. At each stage of the three phases, Figure 4.20 displays a simple moving average as it encounters the trend and consolidation phases. By applying popular multiple moving average lines, the behavior of By applying popular multiple moving average lines, the behavior of moving average averages with respect to trends and consolidations becomes more evident. During trending phases, the moving average displays the minimum incidences of whipsaws, but during any consolidation phases it will exhibit a significant increase in whipsaw action due to the flattening out effect of averages in a sideways or ranging market. 4.5 Divergence and momentum interpretation of market phase. Market phase may also be identified to some degree via the use of divergence analysis. Divergence may be used to track the changes in price momentum and therefore is extremely useful for identifying potential consolidations as well as the strength of a trend. The accumulation is further supported with standard bullish divergence on the moving average convergence divergence indicator MACD. The left shoulder, head, and right shoulder coincided with the projected cycle lows that underlie 3M company. The existence of this bullish confluence within the accumulation greatly increases the probability for a strong upside move. In Figure 4.24, we see a volume, MACD, and the relative strength indicator, RSI, all indicating bullish divergence with the price within the accumulation. Both the MACD and RSI are momentum-based indicators. We see momentum turning before price. This is particularly useful, especially at the tail end of a trend, where a clear indication that a consolidation may be forming could help the trader anticipate an early entry. Note that for bullish divergence in volume, falling prices must be accompanied by decreasing volume. 4.6 Sentiment interpretation of market phase. Examples of some sentiment indicators are put-call ratios, arms index, odd lot sales, margin debt, COT report, VIX, short interest ratio. Short interest ratio, cash asset ratio, advanced decline line, new highs, new lows, up volume, down volume, market vein reports, bullish sentiment index. 4.7 Sakata's interpretation of market phase. Sakata's 5 methods is a unique Japanese approach for interpreting and understanding the markets. The 5 distinct phases are 1. Sanzan, 3 mountains. This is equivalent to the Western Triple Top Formation, which represents the distribution phase. 2. Sansein, 3 rivers. This is equivalent to the Western Triple Bottom Formation, which represents the accumulation phase. 3. Sanku, 3 gaps. This is equivalent to the Western Triple Gap Formation, which occurs during the trending phase, popularly known as the breakaway, runaway, and exhaustion gaps. 4. Sanpei, 3 thrusts. This represents the 3 trending phases between accumulation and distribution. This closely resembles Elliott's 3 impulsive numbered waves 1, 3, and 5. 5. Sanpo, 3 methods. This represents the three corrections after each thrust. This somewhat resemble Elliott's three corrective waves lettered as A, B, and C in upcoming figure 4.28. 4.8 Elliott's interpretation of market phase. Elliott described the markets as moving in an impulsive 5-wave up followed by a corrective 3-wave down motion. The trending phase is represented by impulse waves. Waves 1, 3, and 5. The accumulation phase is represented by the corrective waves 2 and 4, and in most cases including the entire ABC correction itself. Distribution. Notice that volume gradually decreases as seen within the accumulation phase, followed by the powerful wave 3 move during the first trend phase. 4.9 CYCLA Analysis Interpretation of Market Phase. We may also use market cycles to determine if a price formation is potentially a reversal or a continuation. As a general guideline for formations unfolding on the same cycle degree. 1. Formations that lie in between cycle extremes tend to be continuations. 2. Formations that lie at cycle peaks tend to be distributions. 3. Formations that lie at cycle troughs tend to be accumulations. Note that if the intrinsic and extrinsic biases for the chart patterns are in agreement, reversals and continuations will potentially be more reliable. In figure 4.31, we see the intrinsically neutral symmetrical triangle adopting three distinct roles, representing accumulation at the bottom of the cycle, continuation in between the top and bottom of the cycle, and distribution at the top of the cycle. Chapter Summary. We have seen how various market phases may be determined and identified via the application of chart patterns, moving averages, volume and open interest cycles, sentiment indicators, and Elliott wave analysis. We have also seen how Eastern and Western approaches to market phase may be complementary to each other. Chapter 5. Trend Analysis. Trend trading has transfixed traders for decades with the promise of rapid profits. 5.1 Definitions of a trend. Classification of a trend according to Dow theory. In Dow theory, trends are classified and defined by their duration and extent. Primary or major trends are longer term and span from months to years. Secondary trends or reactions are medium term and span from weeks to months. Minor trends are shorter term and span from days to weeks. In Dow theory, an uptrend is defined using peak and trough analysis. An uptrend is represented by a series of successively higher highs, peaks, and lows. Troughs, while a downtrend is represented by a series of successively lower highs and lows. This is the most popular definition of a trend. See figure 5.3. Under peak and trough analysis, Under peak and trough analysis, trend actions in scenarios 1 and 2 satisfy the conditions for being classified as uptrends because they exhibit a series of higher highs and lows. But what about trend actions in scenarios 3 and 4? There are no higher highs or lows in scenario 3 and no highs or lows whatsoever. In scenario 4, do we classify them as uptrends? Under Dow's peak and trough definition, they do not classify as uptrends. To avoid the dependence on a particular price behavior as a means of identifying a trend, many practitioners choose to use other means of trend identification, such as price remaining above or below an overlay indicator, price remaining above or below an arbitrarily chosen price level, the absence of a reversal of a specified amount during a trend. One popular example of price remaining above or below an overlay indicator in order to qualify as a trend is best illustrated via the use of trend lines and moving averages. With respect to other price overlays, the trend is considered to still be intact if price remains above the Bollinger, linear regression, and moving average lower band in an uptrend, the converse for downtrends. Price remains above the lower boundary of a chart pattern in an uptrend, the converse for downtrends. One 128. Some practitioners also define a trend by its ability to remain above or below some arbitrarily chosen price level. As long as price remains above a chosen support level, an uptrend is considered to still be intact. Similarly, as long as price remains below a chosen resistance level, a downtrend is considered to still be intact. This chosen price level may represent some historically significant support level in an uptrend or resistance in a downtrend, the violation of which would imply a very high probability of the trend reversing. A third method of identifying an ongoing trend is via the absence of a reversal of a specified amount during a trend. This third approach is employed on constant range charts such as point and figure and Renko charts, describing consolidation and trends via wave cycles and degrees. It is also important to be able to describe and identify trends and consolidations in terms of wave cycles or degrees. We may describe any trend or consolidation in terms of wave cycles, which exist at various wave degrees. Higher wave cycle HWC, highest wave degree relative to the MWC and LWC. Medium wave cycle MWC, a subwave of HWC and is of a lower degree than the HWC. Lower wave cycle LWC, a subwave of both the HWC and MWC and is at the lowest wave degree. The MWC and LWC are both subwaves. The MWC and LWC are both subwaves of the HWC and are regarded as wave cycles of lower degrees. Without knowing which wave cycle is being traded, any of the following scenarios may result: inability to select consistent breakout levels, inability to select effective stop loss levels, inability to apply effective stop sizing, inability to distinguish between trend and consolidation mode, inability to determine the direction of the predominant trend. As seen in the figure 5. As seen in the figure 5.7, a market may be both in trend and consolidation modes at the same time, depending on the wave cycle being observed. We may also define breakouts via the degree of the wave cycles. Figure 5.8 illustrates breakouts in terms of the wave degree being traded. Hence, we have breakouts based on waves of lower, medium, and higher degrees. In other words, the breakout level will depend on the wave degree being traded. Being aware of the wave degree being traded will allow the trader to size the stop loss effectively according to the average wave amplitude and volatility associated with that particular wave degree. Volatility at one wave degree may not manifest at a higher or lower wave degree. Significance of higher wave degree reversals. When a large wave cycle or trend reverses all the wave cycles of lower degrees reverse in sync with the larger wave cycle. Reversals, corrections, and retracements. Reversals and retracements imply a turnaround in prices. Reversals and retracements imply a turnaround in prices and may be of any amount or degree. Corrections and pullbacks tend to imply a more shallow reversal or retracement, usually no more than a few percent. Trends in terms of OLC data. Trend may also be defined in terms of individual open, high, low, and close. OHLC data. Figure 5.10 depicts various trend activity with respect to the high, low, close, and mid typical prices. This is essentially a line chart in action. Hence, as far as close prices are concerned, it is clearly an example of an uptrend unfolding. 5.2 Quality of trend, 16 Price characteristics. I impacting future price ACTN and trend. Strength. The highest skill any trader can aspire to is the ability to read pure price action. This is an important skill because price is regarded as the most important indicator of potential future price action. 1. Cycle amplitude. Look for decreasing cycle amplitude in uptrends and downtrends. A decrease in cycle amplitude in an uptrend is an early indication that there may potentially be underlying weakness in the uptrend. See figure 5.11. In similar fashion, a decrease in cycle amplitude in a downtrend is regarded as a bullish indication. Note that the up cycle amplitudes must on average be larger than the down cycle amplitudes for an uptrend to take place. Conversely, for a downtrend, the up cycle amplitudes must on average be smaller than the down cycle amplitudes. Nevertheless, it is the change in the successive up and down cycle amplitudes that are the most important characteristic for deciphering future price activity. Contracting formations are bearish in Contracting formations are bearish in an uptrend and bullish in a downtrend. Expanding formations, where both upper and lower boundary trend lines are pointing in an upwardly direction, are generally bullish in an uptrend. 2. Cycle period. Decreasing cycle periods are also an early indication of potential weakness in a trend. A gradual reduction in the cycle period during an uptrend is an early indication that there may potentially be underlying weakness in the uptrend. 3. Bar retracement symmetry. A change in the 3. Bar retracement symmetry. A change in the number of bars in a retracement is also an early indication of a potential change in trend behavior. 4. Average bar range. A decrease in the average bar range in an uptrend is an early indication of potential weakness in an uptrend. In a similar fashion, a decrease in the average bar range in a downtrend is a bullish indication. Figure 5.16 shows a declining ATR during a steady uptrend in the GLD. SPDR Gold Trust shares. Although volume is bullish, the ATR is indicating otherwise. A large bearish candlestick completes the bearish picture. Price declined after the volume climax. 5. Price persistence. Continuity of 5. Price persistence. Continuity of trend action. Prices tend to persist for longer periods when prices of high quality prices have relatively small bar ranges, approximately equal bar ranges. 6. The average bar stochastic ratio. Closing price compared to bar range. A gradual decline in close prices with respect to the bar itself is also an early indication of potential weakness in an uptrend. In a similar fashion, a gradual increase in close prices with respect to the bar itself is also an early indication of potential bullishness in a downtrend. We measure this increase or decline in close prices with respect to the bar itself as a ratio, and it is referred to as the bar stochastic. Unlike the standard stochastic oscillator, which compares the relative position of the closing price over the last 10 periods, the bar stochastic measures the relative position of the closing price within the bar itself. It is essentially a 1 period percent K. A simple moving average of the bar stochastic ratio is used to monitor this price action behavior. See Figure 5.18. Figure 5.19 depicts a 3-period SMA of the bar stochastic accurately identified. Figure 5.19 depicts a 3-period SMA of the bar stochastic accurately identifying bearish divergences in uptrends and bullish divergences in downtrends. 7. Average candlestick real body to range ratio. A gradual decrease in the real body to candlestick range is also an early indication of potential weakness in an uptrend. In similar fashion, a gradual decrease in real body to candlestick range is a bullish indicator in a downtrend. 8. Angular symmetry and momentum. Any change in the angular 8. Angular symmetry and momentum. Any change in the angular symmetry is also an early indication of potential bullishness or bearishness in the markets. Generally speaking, an increase in the angle of ascent is bullish for the stock while a decrease is bearish. Trend lines 1 and 2 are also parallel, which is a strong prognosticator of potential bullishness. A minor correction at point 3, which represents potential resistance from an over overbought angular perspective. Note that a bearish rising channel is seen developing above trendline 2, helping to strengthen the case that a minor correction is highly probable. In fact, 3M Co. went on to rise above $140 after correcting at point 3, not shown on the charts. In figure 5.22, an upside acceleration in price is bullish whereas an upside deceleration in price is bearish. Similarly, a downside acceleration in price is bearish whereas a downside deceleration in price is bullish. Upside and downside acceleration is normally parabolic in nature. Such rapid increases in price usually end in a blow-off or buying climax with prices subsequently collapsing. Similarly, downside acceleration in prices may also end in a selling climax. The price action depicted in figure 5.23 shows an even more potentially bearish scenario in an uptrend. Here we have both a deceleration in prices, well as a diminishing bar rate. Well as a diminishing bar range. In figure 5.24, we see gold with a consistent trend rate of approximately $3.30 per day. Notice that once the trend rate changes, the behavior of the market also switches to a new regime, displaying greater volatility and larger swings in price. 9. Barrier proximity. There is always a high probability that a trend may reverse as it approaches a strong and significant price barrier. In figure 5.25, we observe the price for A-shares MSCI Emerging Markets Fund rebounding after testing a strong and significant support level. 10. Frequency and depth of trend-based oscillations. An uptrend is considered Te- 10. Frequency and depth of trend-based oscillations. An uptrend is considered to be more reliable if it displays a reasonable number of oscillations. Oscillations should be fairly frequent and not too shallow or too deep. Such a trend is indicative of healthy profit-taking activity, with some profit taken off the table. As the trend unfolds, traders and investors tend not to react as emotionally and irrationally at higher prices where the risk of losing pent-up and unrealized profit is greater. Of pent-up and unrealized profit at risk, there is a high probability of pent-up and unrealized profit at risk, there is a high probability that traders and investors will rapidly exit the market at the slightest hint of bearishness. This makes such a trend potentially more bearish at higher prices. In figure 5.27, we see Apple Inc. prices oscillating in a steady, rising channel. This was subsequently followed by rapidly rising price with the minimum of oscillations, as prices rise the second time toward the historical high. In Apple, they do so in a similar uptrend rate with relatively little profit taking. Between timelines 1 and 2, we see the ATR declining as prices rise. This is a bearish indication. We see Apple prices decline substantially thereafter. Note that profit-taking activity in the form of price oscillations also occurs at various wave degrees within a trend. 11. Relative measure of consolidation size and duration. Trend interruptions are more significant if price formations are of greater magnitude, taller chart patterns. Price formations develop over a longer period, wider chart patterns. In a strong uptrend, a larger head and shoulders formation would be deemed more bearish than a smaller formation. Similarly, a larger rounding bottom formation would be more bullish than a smaller one in a downtrend. In short, size takes precedence over form. Moreover, the longer it takes for a consolidation to unfold, the greater will be its disruptive power with respect to the trend, should a reversal occur. 12. Third gap exhaustion. The appearance of a third gap in a trend is also an indication of potential trend exhaustion and a possible reversal. Prices finally bottomed after the appearance of another third gap in the subsequent downtrend, which the appearance of another third gap in the subsequent downtrend, which again coincided perfectly with the cycle-tuned stochastic at oversold. 13. Completion of the average period range. One of the most reliable characteristics of price activity lies with its average period range, with the period being any chosen duration of observation. For example, let us assume that the average daily range of a certain forex pair is 120 pips per day. Once the average range is breached prematurely, the practitioner begins to look for various signs of a reversal, paying special attention to supportive and resistive confluences. The use of the average true range indicator ATR set to a reasonable look-back period on an interval chart of interest. By finding the two standard deviation value of bar range over a certain number of periods. 14. Overextended price action with respect to an overlay barrier. Any price penetration above an uptrending line is generally regarded as a potential sign of exhaustion, with a reversal expected. Exhaustion, with a reversal expected. Similarly, a reversal is expected for any price penetration below a downtrending line. It should also be noted that any short-term penetrations below an uptrending line or above a downtrending line are usually regarded as false breakouts rather than being specifically categorized as overextended. See figure 5.29. 15. Volume spread action. The relationship between volume and price is most significant when price and volume exhibit extreme behavior. Very large bar range accompanied by very large volume. This is normally regarded as trend promoting, being a potentially bullish sign when the bar closes at or very near the high. In an uptrend, this would suggest a strong continuation of any existing uptrend and reversal of any exiting downtrend. Very large bar range accompanied by very low volume. This is normally regarded as trend inhibiting, although not necessarily as an indication of a potential reversal. It implies a lack of commitment underlying the price move. Very small bar range accompanied by very large volume, this is also normally regarded as trend inhibiting and is regarded as a significantly stronger indication of a potential reversal. It shows that even with such a large commitment in capital, there was no further extension in price, implying a strong opposition to the existing trend. This is popularly referred to as a squat bar. Very small bar range accompanied by very low volume, this is normally regarded as trend inhibiting, although not necessarily leading to a potential reversal. 16. Volume and oscillator divergence, the appearance of standard or reverse divergence between price and volume, or with any oscillators, may give an early indication of potential reversals or continuations in the market. 5.3 Price and trend filters. The exact point of entry and exit, or breakout and reversal, is determined by the type of filter and the extent to which it is employed. A trader can initiate trades based on intraday breakouts without the use of a filter, but that will not be an effective approach, as it would make backtesting virtually impossible, rendering a profitable trading performance unrepeatable. Price-based, time-based, event-based. The entry trigger characteristic associated with each category of filter is as follows. Price-based filters indicate the exact price of entry but do not indicate when an entry will be initiated. Time-based filters indicate the exact time of entry but do not indicate the price at which an entry will be initiated. Event-based filters do not indicate the exact price or time of entry until an event has occurred. Within each broad category of filters, there are subcategories, namely 1. Price-based filters. I. Absolute measure. Fixed price excursion. E. Relative measure. Percentage of breakout price. E. Volatility measure. Multiples of average true range. Multiples of standard deviation. 2. Time-based filters. I. Duration of enclosed bars. 3. Event-based filters. I. Algorithmic filters. Specific sequence of closed bars. Sequence of new highs or lows. E. Event-based measure. Closing price violation. Barrier retest after a confirmed breakout. See figure 5.30. There may be scenarios where two-stage filtering may be required in order to contain and limit the maximum risk allowable per any single trade under the rules of money management. Without controlling the maximum risk allowable per any single trade, the trading system may eventually experience risk of ruin. This is why price-based filters are the preferred mode of filtering. As an example, let us assume that a trader has decided to use a closing violation as the trigger for as the trigger for entry. The problem with closing violations is that prices may close too far beyond the entry level. To prevent this, an additional price-based filter is used to limit entry to within a specified distance. In essence, the trader is primarily employing the closing violation as an entry trigger, but is depending on the price-based filter to limit risk should the violation be overextended. In short, double filtering is especially useful when employing time or event-based filters, since these filters do not specify the exact price of entry, making the controlling of risk ineffective and inefficient, if not impossible. 5.40 Rent participation. Participating in the market. There are 4 basic ways of entering and exiting the markets, namely to go long, buying to open a new position; to go short, selling to open a new position; to liquidate, selling to close an old long position; to cover, buying to close an old short position. If a trader holds no open positions in the market, the trader is said to be in cash. To square a position is to exit it. Traders may also reduce or neutralize all directional risk by hedging their positions with equal and opposite positions. In the market, buying at the current price is also referred to as buying at the market. Figure 5.31 depicts
जिममध्ये वही पेन घेऊन येतो चुत्या घेऊन येतो तो बोलतो आज मला हे करायचं आहे त्याने लिहून काढलं ते
Figure 5.31 depicts the actions of a market participant trading according to the principle of buying low and selling high, which involves any of the four following scenarios: buying low and selling high, buying high and selling higher, selling high and buying back lower, selling low and buying back even lower. Orders for entering and exiting a position. There are two basic types of orders that will allow traders to participate in the market: stop entry and stop exit orders. Essentially, stop orders are instructions to enter or exit a market immediately, at any price. A stop order cannot guarantee that an order will be executed or filled at the specified price, but it can guarantee execution. When entering the market at the current price, we use a market order. Stop entry and stop exit orders may be placed in the market as pending or working orders. Once triggered, all stop entry and stop exit orders turn into market orders. Orders can also be placed instantaneously as market orders. For entry, either a buy stop or sell stop order may be placed. For exiting, if price moves adversely against a position, a stop exit order may be employed, normally referred to as a stop loss order. Pending stop entry orders are usually placed when a continuation in price is expected. Stop loss orders may experience additional loss under gapping price action due to negative slippage. Slippage is the difference between the specified order price and the actual filled price. Limit entry and limit exit orders. Limit orders are instructions to enter or exit a market at a specified price or better. If the broker cannot fill the order at the specified price or better, the order will not be executed. Orders can guarantee that an order will be filled at the intended price or better, but they cannot guarantee that an order will be executed. For entry, either a buy limit or sell limit entry order may be placed. For exiting, if price moves favorably with respect to a position, a limit exit order may be employed, normally referred to as a take profit order. Limit entry orders are usually placed when a reversal in price is expected. Profit take orders can potentially exit with greater profit under gapping price action. Only positive slippages possible with limit orders. 1. Entries above the market. For entries above the market, a trader may place a buy stop entry order if the trader believes that prices will rise higher. Conversely, if a trader believes that prices will reverse at a certain level above the market, a trader may place a sell limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified entry price or better, that is, higher. To short above the market using a stop order, a trader may use a market if touched MIT sell order. 2. Exits above the market. For profit taking above the market, a trader may place a sell limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting loss above the market, a trader may place a buy stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 3. Entries below the market. For entries below the market, a trader may place a sell stop entry order if the trader believes that prices will continue to decline. Conversely, if a trader believes that prices will reverse at a certain price below the market, a trader may place a buy limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Too long below the market using a stop order, a trader may use a market if touched MIT by order. 4. Exits below the market, for profit taking below the market, a trader may place a buy limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting losses below the market, a trader may place a sell stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 5. Entries and exits at the market. For entry at the current price, a market order is used. The entry is instantaneous, but there is no guarantee of being filled at the indicated prices on at the indicated prices on the quote screen. Negative slippage may sometimes occur when placing market orders. Other orders include day orders instruct the brokers to keep an order pending only until the end of the trading day. Good till cancelled orders instruct the brokers to keep an order active until further notice. Market on close orders to buy or sell are executed during the last minutes of the trading day at or near the closing price. Contingent orders are orders that are executed once another order is filled or triggered. Examples include one cancel other OCO and one trigger other. Auto orders. 5.5p Rice inflection points. The 4 modes of initiating trend capture. There are 4 simple ways of initiating or establishing an entry in the market. Namely via overlay breakout entries. An entry may be initiated on an upside or downside breakout of a price overlay that may or may not be in the direction of the predominant trend. Overlay barrier entries. A barrier entry may be initiated at an overlay boundary that may or may not be in the direction of the predominant trend. A barrier entry means buying at a barrier support and shorting at a barrier resistance. Barrier entries also include buying or shorting at a retest of a barrier. Failed breakout entries. An entry may be initiated in the opposite direction after a failed breakout, which may or may not be in the direction of the predominant trend. Random entries. An entry may also be initiated in a random fashion. Pattern, sequence-based entries. Entries that are initiated after a particular sequence of bars have unfolded, algorithmic, or after a pattern is completed. For example, DMARC sequential and Japanese candlestick entries. General scenarios for market tops and bottoms. As we learned in chapter 4, there are basically 3 variations of a market top and bottom. See figure 5.33. Examples of a more complex top or bottom would be a head and shoulders formation, a broadening formation, an island, a diamond formation, and a rounding top or bottom. Swing points and barrier strength. An inflection point such as a peak that is flanked by a larger number of bars on either side of the bar with the highest price is generally regarded as a more significant peak. As such, the resistance level associated with such a peak will be regarded as a significant and strong barrier to price. The resistance and support levels associated with peaks and troughs that are flanked by a smaller number of Bars on either side of the highest or lowest bar are considered to be less significant and reliable. N bars on either side of the highest peak or lowest trough is referred to as an inflection point of strength N. Support and resistance role reversals. Support turns into future resistance. Resistance turns into future support. Figure 5.36 shows price finding support and resistance at prior peaks N. Figure 5.36 shows price finding support and resistance at prior peaks and troughs, as well on the rising channel on the 30-min chart of the EUR/USD. Trading in the direction of the trend. To trade or initiate positions in the direction of the existing trend means to buy in an uptrend and short in a downtrend. It is generally easier and safer to trade in the direction of the existing trend for a variety of reasons, some being buying dips in an uptrend and selling rallies in a downtrend gets the trader into positions where positions are initiated at the most advantageous prices with the smallest stop sizes possible. The trader is able to hold on to positions initiated in the direction of the existing trend and as a consequence extract greater profit from the markets. Buying on a dip and selling into a rally are examples of retracement entries taken in the direction of the existing trend. Figure 5.37 illustrates buying on dips in an uptrend and selling into bear rallies in a downtrend. A trader may use simple up and down trend lines or channels to time the retracement entries. The use of a cycle-tuned oscillator will also help fine-tune the entries. Trend filters. A trend filter helps to identify a trend amidst the market noise and price volatility. Below are 3 popular trend filters used to achieve such an objective, which is by no means exhaustive. Via a double moving average crossover, with the shorter crossing above the longer moving average signifying the start of a potential uptrend and the shorter crossing below the longer moving average signifying the start of a potential downtrend. Via longer-term oscillator signal line crossovers, with the oscillators crossing above its signal lines signifying potential longer-term bullishness and oscillators crossing below its signal lines signifying potential longer-term bearishness. Via the containment of prices above or below overlay barriers such as moving averages or trend lines, with price staying above the moving average or trend line signifying that an uptrend is still intact and price staying below the moving average or trend line signifying that a downtrend is still intact. One popular approach is to use the oscillator signal line crossovers in an uptrend or downtrend to time entries with the use of either an MACD signal or zero line crossover or a double moving average crossover as a trend filter. Figure 5.38 illustrates an MACD filtered stochastic crossover trigger to time entries into the market. Long entries are initiated every time the stochastic crosses above its signal line with the MACD above its zero line. Short entries are initiated every time the stochastic crosses below its signal line with the MACD below its zero line. Zero line. The stops are set to trail price by advancing to the next lower peak in a downtrend or to the next higher trough in an uptrend. Note that the divergence in the MACD helps to warn the trader of a potential reversal. Stop sizing issues related to stop placement. A stop is usually placed just below significant troughs for long positions in an uptrend and just above significant peaks for short positions in a downtrend. For entries too far from a significant peak or trough, a stop may be placed at some multiple of ATR or standard deviations away from the entry. Stop sizes associated with barrier entries will always be approximately the same size as the significant peak or trough is usually the point of entry itself. The stop losses will therefore be placed just behind the barrier, depending on the extent of price filtering employed. Stop sizes associated with breakout entries present a completely different scenario. Stop sizes for breakouts will vary with each entry, since the significant peak or trough associated with each entry may vary in distance from the entry. This presents a significant problem to traders risking a fixed percentage or fixed unit size per trade. The varying trade size associated with the changing stop size for breakout entries will affect the performance of the system, especially if a fixed percentage of current capital is exposed per trade and narrow stops are taken out frequently, causing significant loss. A fixed percentage of original capital is exposed per trade and wide stops are taken out frequently, causing significant loss. The procedure for determining the proportional trade size is as follows. 1. Do a backtest to find the average stop size for at least 300 to 500 trades if possible. 2. Calculate the 2 standard deviation value based on all the stop sizes in the sample. 3. Add this 2 standard deviation value to the average stop size. This represents the proportional stop size. 4. Determine the maximum percentage of current capital to risk for each trade and calculate its corresponding dollar value risk per trade. 5. Divide this dollar value risk per trade by the proportional stop size. This represents your proportional trade size. Therefore, the trader would initiate trades based on the proportional trade size for all trades where the stop size is at or below the proportional stop size. For stop sizes that exceed the proportional stop size, calculate the trade size by simply dividing the maximum dollar value risk per trade by the stop size. The term proportional refers to the percentage risk allocated per trade that is initiated for entries with stop sizes at or below the proportional stop size. 5.6T Rendell in S channels and fan lines. Provisionary, tentative, and confirmed valid trend lines. For uptrends, a line is drawn between 2 significant troughs and projected into the future, whereas for downtrends a line is drawn between 2 significant peaks and projected into the future. A trend line is said to be only provisionary or tentative until it is tested for the first time, that is, at the third point of price contact on the trend line. Once tested, it is then regarded as a confirmed or valid trend line. All trend lines are drawn between 2 inflection points except for bullish support lines and bearish resistance lines in point and figure charting, where only one reference point is used. Short, medium, and long-term trend lines. A trend line may be defined as short, medium, or longer term depending on the amount of price activity it contains above or below it. Trendline support and resistance, the behavioral component. As mentioned in an earlier section, all price overlays, including trend lines, represent barriers to price action. As barriers they provide support and resistance to price at the trend line, while price approaching a trend line from below will potentially experience resistance. This occurs because most market participants will usually place buy orders above a barrier and short orders below it, invalidating and redrawing trend lines. A trend line is invalidated once it is breached. See figure 5.41 for an example of an invalidated trend line and the redrawing of a new trend line. The new trend line is drawn between the new significant trough and the original lower trough in an uptrend. For downtrends, the new trend line is drawn between the new significant peak and the original higher peak. Once a trend line is invalidated, it is thereafter referred to as an internal line. Use only price-based filters and avoid time and event-based filtering. This This would allow the trader to decide exactly how much price excursion is required to represent a valid penetration of a trend line, or for that matter, any price barrier. Even if the amount of price excursion fails to be recognized as a valid penetration, this does not mean that a new trend line cannot be drawn. Use double-stage filtering when employing time or event-based filters to gauge valid trend line or price barrier penetrations. As long as the second filter is price-based, the trader would be able to identify a valid penetration once the price exceeds a specified price. As before, this does not preclude the drawing of a new trend line, even if the intraday or intra-period penetration has not exceeded the second filter's validation price. Elements of trend line reliability. What constitutes a reliable trend line? Quite simply, a reliable trend line may be defined as a trend line that provides consistent support and resistance to price action. A trend line that experiences a lot of whipsaws is considered unreliable. Angle of trend line, a steep uptrend, that is above 45 degrees, is usually regarded as less stable and may not be able to sustain itself over the longer term. Any trend line associated with such a trend is therefore deemed less reliable. A weak trend with a very shallow angle of ascent is also regarded as less stable, and any trend line associated with such a trend is also deemed less reliable. As such, a longer-term trend line will attract a larger number of buy orders above it and sell orders below it, and in the process transform into a stronger and more significant barrier to price. This makes longer-term trend lines more reliable. Longer-term trend lines also attract the institutional players, resulting in larger orders placed at the trend line, giving rise to a stronger inhibiting effect with respect to price. Number of price retests. The greater the number of retests a trend line experiences, the more indicative it is that traders are aware and paying attention to a trend line. Such a trend line will normally attract more orders around it as traders realize that it is rejecting price in a consistent manner. Confluence with other indicators. The more confluence or convergence there is with other bullish or bearish indicators at the point of contact on the trend line, the stronger will be the rejection of price at the trend line. Preceding action, the contraction of cycle amplitude, cycle period, bar range, and body to range ratio are indications of a potentially weak uptrend and a potentially bullish downtrend. As such, this makes any trend line associated with such trends also suspect and unreliable over the longer term. Strengths and weaknesses of trendline analysis. Strengths. Trend lines, being straight lines, will catch any trend changes effectively. Trend lines are able to identify trends without the need to identify specific price. Patterns and formations. It is simple to construct and may be applied across all timeframes and markets with equal ease. A trend line is viewable across all timeframes. Weaknesses. Trend lines, just like moving averages, are also subject to whipsaws and are less effective in erratic, volatile, or ranging markets. Because trend lines are geometrically based overlays, they are affected by the type of scaling used, that is, ratio or linear. Consolidation may cause a trend line. Consolidation may cause a trend line to be breached at some point in time, in the absence of a legitimate trend reversal. Continuation and reversal trendline entries. We may also classify trend lines as reversal or continuation in the following manner. Trend lines that allow breakout in the direction of the existing trend are referred to as continuation trend lines. Trend lines that allow breakout in the opposite direction to the existing trend are referred to as reversal trend lines. Channel construction. Channels may also be created by projecting a trend line from a significant peak or trough that is parallel to the uptrend or downtrend line. Channels are useful in that they indicate potential entry levels, profit-taking levels, future price targets, stop-loss levels. Figure 5.44 illustrates the construction of a rising channel. First, draw an uptrend line based on two significant troughs indicated at points 1 and 2. Then locate a significant peak above the trend line, which in this case would be the peak. At point 3, draw a line parallel to the uptrend line from the peak at point 3 and project it upward. This projected line is called the channel or return line. Formation constitutes a rising channel. To draw a falling or declining channel, we first draw a downtrend line based on two significant peaks indicated at points 4 and 5. We then draw a line parallel to the downtrend line from a significant trough indicated at point 6 and project it downward. Notice that the trough at point 6 has violated the uptrend line, which may be an early indication of a potential trend change. We see the rising channel transitioning into a falling channel. Nested channels. Figure 5.45 shows silver price transitions within a larger falling channel. We say that the smaller channels are contained or nested within the larger channel. Channel nesting can occur at multiple levels, with large channels comprised of ever decreasing channel sizes. In essence, channel nesting has fractal-like properties. Price target projection. Channels are extremely useful for projecting potential price targets. Figure 5.47 illustrates the use of the return line as a possible price target, providing resistance to the motion of price. The price targets at points 5 and 6 were forecasted accurately via channel projection, anticipating channel breakouts. It also should be noted that if the subsequent price action fails to test either one of the channel boundaries, it may be an early indication of a possible channel breakout in the opposite direction of the failed price retest. Uptrend in a channel top in a down. Uptrend and a channel top in a downtrend represent even stronger evidence of a potential continuation of the existing trend. Notice that price failed to test the lower channel boundary, which was followed by a strong continuation of the existing uptrend. Note also the large channel breakout bar at point A. Sparandio and DMARC trend lines. Victor Sparandio introduced a powerful way of drawing trend lines in his book, Trader Vic. Trader Vic Methods of a Wall Street Master. For more details about his approach, the reader is advised to read his book, Lowest Trough to the Highest Minor Trough Preceding the Highest Peak for Uptrend Lines. Highest peak to the lowest minor peak preceding the lowest trough for downtrend lines. Thomas DeMark introduced a more responsive approach to drawing trend lines in his book The New Science of Technical Analysis. The reader is advised to read his book for a full treatment of pivot selection process and other prerequisites necessary for the correct drawing of DeMark trend lines. The two most recent qualified troughs in an uptrend. The two most recent qualified peaks in a downtrend. Standard fan lines. Standard fan lines. Standard fan lines indicate a change in trend. The violation of the third fan line represents strong confirmation of a trend change. As with all types of fan lines, they provide support and resistance to price action. When support is breached, it turns into resistance, and vice versa. They are traded in a manner representative of any trend line. To construct accelerating fan lines, locate a significant higher peak and draw a downtrend line, connecting this significant peak to gradually rising lower peaks. Only draw 3 downtrend lines. To construct decelerating fan lines, locate a significant lower trough and draw an uptrend line connecting the significant lower trough to gradually declining higher troughs. Only draw 3. Only draw 3 uptrend lines. Fibonacci fan lines. Fibonacci fan lines are created in a slightly different manner as compared to standard fan lines. Here is how to construct a bearish Fibonacci fan line. Identify a significant Fibonacci retracement range. Draw a vertical line from the peak of the retracement range to the trough's price level. Divide the vertical line into 38.2, 50, and 61.8% levels. Project 3 lines from the trough intercepting the 3 retracement levels located on the vertical line. Speed lines. Edson Gould's speed lines also track the progress of a trend as it attempts to bottom or top. Speed lines are created in exactly the same way Fibonacci fan lines, except that the retracement ratios are 1/3 and 2/3. Other types of trend overlay indicators. Andrews pitchfork. Andrews pitchfork is a geometrically Andrew's pitchfork is a geometrically based price overlay indicator. The projected lines provide support and resistance to price action. To construct the bearish Andrew's pitchfork, we need to find a significant peak, identify a subsequent upside retracement back up to the peak but not exceeding it, find the midpoint between the retracement trough and the retracement peak, draw and project a line from the significant peak through this midpoint referred to as the median line. Project lines parallel to this median line from the retracement peak and retracement trough. 5.70 rend retrace. 5.70 rend retracements. Retracements Dow, Fibonacci, and Gann 1/3 and 1/8. There are various approaches to measuring trend retracements. Fibonacci retracements are based on various ratios related to the Fibonacci phi ratio. Dow paid particular attention to the 1/3 and 2/3 retracements, while Gann employed 1/3 and 1/8 retracement ranges. Probably the most important retracement percentage of all is the 50% retracement level. Both Gann and Dow regarded 50% as the most significant retracement percentage, with most major tops and bottoms forming around this retracement level. We see strong convergence of retracement percentages around specific retracement ranges, especially between the 33 to 38.2%, 50%, and 61.8 to 66% ranges. 5.8 GAPS and trends. Gaps help to define various stages within a trend, which helps to provide an indication of potential tops and bottoms in the market. There are basically 4 types of market gaps, namely 1. Common gaps, gaps that occur within a trading range considered insignificant. 2. Breakaway gaps, gaps that are created as price breaks away from a consolidation or chart pattern. 3. Runaway, measuring, midway, continuation gaps, gaps that are created in a strong trend phase. There may be more than one runaway gap appearing in a strong trend. 4. Exhaustion gaps, gaps that are created at the end of a trend after which a consolidation or reversal occurs. It is indicative of potential trend exhaustion. We see common gaps within the consolidation phase followed by the trend-related gaps. We see prices top after the third gap, which represents potential trend exhaustion. We see the same trend exhaustion occurring at a significant We see the same trend exhaustion occurring at a significant resistance level created by a strong price rejection at the high of a very bearish shooting star pattern. It must also be noted that gaps tend to create areas of potential support and resistance. 5.90 rend directionality. A unidirectional A unidirectional entry is a trade taken only in the direction of the existing trend, be it to the upside or downside. A bidirectional entry is a trade taken in either direction, depending on which way the breakout occurs. Figure 5.58 illustrates how very short-term or micro unidirectional entries are equivalent to a longer-term or macro bidirectional trading approach. Assume that a trader only initiates a breakout in the direction of the existing trend. The trader would be initiating long position in an uptrend and short positions in a downtrend. Over the long term, this would be equivalent to a longer term bidirectional trader entering the market on a breakout. Hence, we see that even though a trader only trades in one direction at any one time, being unidirectional, over the longer term, this would essentially result as trading bidirectionally in the market as the trend moves up and down. The only condition that would disrupt this equivalence would be if the unidirectional trader did not take every qualified trade. 5.10 Drummond geometry. Drummond's geometry was developed by Charles Drummond over a long period of time. Drummond geometry helps keep the trader on the right side of the markets. It basically consists of a short-term moving average referred to as the PR line, interbar trend lines. The reader is advised to refer to the Ultimate Trading Guide by John Hill, George Pruitt, and Lundy Hill for a detailed look at Drummond geometry. The PR line is represented by a simple 3-period moving average of typical price. To be very brief, when price is above the PR, the market is regarded as bullish, and when price is below the PR, the market is expected to be bearish. Another approach that some practitioners take is to buy when the PR line turns up and sell when it turns down. 5.11 Forecasting trend reversals. 5.11 Forecasting trend reversals. The following is a summary of characteristics associated with forecasting reversals via various forms of technical analysis. For detailed analysis of each approach, refer to the relevant chapters within this handbook. A. Volume divergence. Potential market reversals tend to be accompanied by diminishing volume in an uptrend or downtrend, indicating potential weakness in the trend. Extreme volume in the form of buying or selling climaxes, indicative of market tops and bottoms. B. Chart patterns. Potential market reversals tend to be accompanied by bearish chart patterns occurring after a strong and prolonged uptrend, bullish chart patterns occurring after a strong and prolonged downtrend. The appearance of a large broadening, diamond, or island formation. C. Cycle analysis. Potential market reversals tend to be accompanied by cycle peaks at market tops, cycle troughs at market bottoms, decreasing cycle amplitude during a trend, decreasing cycle period during a trend. D. Oscillator analysis. Potential market reversals tend to be accompanied by overbought signals at market tops, oversold signals at market bottoms, bearish divergence with price at market tops, bullish divergence with price at market bottoms, oscillator crossing below its signal and equilibrium line at market tops, Oscillator crossing above its signal and equilibrium line at market bottoms. A. Candlestick formations. Potential market reversals tend to be accompanied by bearish candlestick formations at market tops. Bullish candlestick formations at market bottoms. F. Intermarket relationship. Potential market reversals tend to be accompanied by bearish action in the broad markets leading to a top in the stock. Bullish action in highly correlated markets leading to a bottom in the stock. G. Support and resistance levels. Potential market reversals tend to be accompanied by market tops at significant historical resistance levels. Market bottoms at significant historical support levels. 5.12 Chapter Summary. In this chapter, we dealt with issues concerning the definition and identification of a trend. We have also discussed various powerful trend indicators that helped identify the early onset of a trend. The practitioner is advised to pay particular attention to the 16 characteristics that may significantly impact the future of price action and potential strength of a trend. Chapter 6. Volume and open interest. Although price is regarded as the best indicator of potential future price behavior, volume and open interest offer additional evidence to corroborate bullish or bearish setups. Volume and open interest can indicate potential underlying weakness and also function as timing indicators for potential breakouts. 6.1 The mechanics of volume ACTON. Dow theory of volume confirmation. We learned in Chapter 2 that under the tenets of Dow theory, volume is expected to confirm the trend, that is, it should expand in the direction of the pre-existing or predominant trend. Volume is regarded as a supporting or secondary indicator of potential future price action. To confirm the trend, volume should increase as price rises and decrease in any downside retracements. In a pre-existing uptrend, bullish volume action, volume should increase as price declines and decrease on any upside retracements. In a pre-existing downtrend, bearish volume action. When studying volume, the practitioner should always remember two basic principles, which are 1. A rise in volume indicates that market participants are interested in seeing K price go higher in an uptrend or lower in a downtrend and are willing to buy higher in an uptrend or sell lower in a downtrend in order to participate in K unfolding market action. 2. A decline in volume indicates that market participants are losing interest in seeing the price go higher in an uptrend or lower in a downtrend and are more willing to buy lower in an uptrend and sell higher in a downtrend, if not exiting positions in the market. Notice that in figure 6.1, both rising and declining volume are regarded as bullish volume if both volume and price rise and decline together in a pre-existing uptrend. Conversely, both rising and declining volume are regarded as bearish volume if volume and price move in opposite directions to each other in a pre-existing. This shows that declining volume does not necessarily This shows that declining volume does not necessarily imply bearishness. And similarly, rising volume does not imply bullishness. The bullish or bearish sentiment associated with volume action depends on the direction of the price. In figure 6.2, we observe volume expanding in the direction of the primary. In figure 6.3, we observe volume action that is not confirming the pre-existing trends. Here we see that both rising and declining volume are regarded as bearish volume if both volume and price move in opposite directions to each other in a pre-existing uptrend. This is an indication of a potentially weak or bearish uptrend. Conversely, both rising and declining volume are regarded as bullish volume if both volume and price rise and decline together in a pre-existing downtrend. Volume confirmation and divergence. This leads us naturally to the concept of volume confirmation and divergence. Simply put, volume divergence occurs whenever volume declines irrespective of the direction of price. Volume convergence or confirmation occurs whenever volume rises irrespective of the direction of price. Volume divergence implies that market participants are not interested in seeing prices rise or decline further. As prices rise and volume subsides, traders and investors indicate that they are less interested in participating in the upside move. This is bearish for an uptrend. Similarly, as prices fall and volume subsides, traders and investors indicate that they are less interested. This is bearish for an uptrend. Similarly, as prices fall and volume subsides, traders and investors indicate that they are less interested in participating in the downside move. This is bullish for a downtrend. Volume convergence, that is volume increasing, is an early indication of a potential continuation of the existing trend. Volume divergence, that is volume decreasing, is an early indication of a potential reversal of the existing trend. Volume divergence always indicates potential weakness in an existing trend, whereas volume confirmation always indicates potential strength in an existing trend. In short, bullish divergence can only occur in a downtrend, indicating a possibility of a potential upside reversal in the trend. Bearish divergence can only occur in an uptrend, indicating a possibility of a potential downside reversal in the trend. Potential downside reversal in the trend. In figure 6.6, we observe bullish volume in periods 1 to 10, except in period 5. In figure 6.6, we observe bullish volume in periods 1 to 10, except in period 5, where the volume action was somewhat flat. Periods 1, 3, 7, and 9 display bullish confirmation, while periods 4 and 6 display bullish divergence. Periods 2, 8, and 10 display volume declining during a consolidation. In a consolidation, volume functions as a breakout timing indicator. We observe that at the end of periods 2, 8, and 10, price experiences either an upside or downside breakout whenever volume declines to its minimum for each period. Summarizing all possible divergent and convergent scenarios. Whenever volume and price are declining together, we have bullish divergence. Whenever volume and price are rising together, we have bullish confirmation or convergence. Whenever volume is declining and price rising, we have bearish divergence. Whenever volume is rising and price declining, we have bearish confirmation or convergence. Reading divergence for volume bars, smoothed volume oscillators, and open interest. 1. Non-price based volume oscillators. 2. Price-based volume oscillators. Price-based volume oscillators incorporate price data in their construction, whereas non-price based volume oscillators only incorporate volume data in their construction. It should be noted that reading price-based volume oscillator divergence differs from reading non-price based volume oscillator divergence. Some popular price-based volume oscillators include on balance volume OBV, accumulation distribution line ADL, Chaikin money flow, Chaikin oscillator, demand index, Herrick payoff index. Some non-price based volume oscillators include standard volume bars, smoothed volume, detrended volume, rate of change of volume rock volume, percentage volume oscillator PVO. Volume as a timing indicator. Volume may also be used as a timing indicator for breakout. Volume may also be used as a timing indicator for breakouts from consolidations. Whenever volume declines close to its lowest historical level, a breakout is expected. This is because all the buyers and sellers who are interested in participating in the stock or market have already done so. An accumulation of stop orders above and below the consolidation over the consolidation period will act as a catalyst for either an upside or downside breakout once triggered. Hence, whenever the volume is testing a significant minimum or its lowest historical levels, a breakout is expected. We refer to this as a low volume breakout signal. Note that there is no divergence reading during a consolidation. Such reversals as low volume reversals. In figure 6.9, we observe price breaking out from an accumulation after volume declined to its lowest level. We also observe two low volume reversals just prior to the consolidation at timelines 1 and 2. In figure 6.10, we observe three consolidation breakouts occurring whenever the lowest or minimum volume level is tested. Notice an increase. Volume weighted average price moving average VWMA. A volume weighted moving average VWMA may also be created to track overvalued and undervalued stock in the market. Typically, price is considered potentially bullish when it is above the VWMA and bearish when below it. For a detailed calculation of the VWMA, refer to Chapter 11. In figure 6.11, we notice price rising decisively every time it crosses above the VWMA and declining in a similar manner when it crosses below it. We also notice that the crossovers occur at the daily volume cycle peaks. It should be noted that the stock is regarded as undervalued if it lies below the VWMA and overvalued if it is above it. Hence, many institutional traders deem it advantageous to only look for buy signals for a particular stock or market when it is undervalued with respect to the VWMA and sell signals when it is above it. Volume buying and volume buying and selling climaxes. A market top or bottom is usually accompanied by either relatively large or extreme volume, relatively low or minimal volume. Here are the four possible scenarios for a top and bottom with respect to volume. 1. A market top associated with 1. A market top associated with extreme volume is called a blow-off or buying. Climax. 2. A market bottom associated with extreme volume is called a sell-off or selling. Climax. 3. A market top associated with extremely low or minimal volume is called a low volume top. 4. A market bottom associated with extremely low volume is called a low volume bottom. It is important to note that overextensions in volume can signal either a top or a bottom. A bottom. Extreme buying and selling activity generates volume and can result in either a top or bottom. That is the reason why we cannot use the terms overbought or oversold with respect to volume extremes unless we are able to associate volume with either a top or bottom formation. Therefore, although we are able to pinpoint overextensions in volume, it is only possible to identify overbought or oversold levels in volume after a top or bottom has already formed, that is, in retrospect. Volume action and the strength of a price barrier. An indication as to the potential An indication as to the potential strength and reliability of a price barrier may also be gauged from the action of volume at or across the point of support or resistance. Figure 6.18 shows two scenarios for resistance and support. Support and resistance formed at a volume peak are generally regarded as the most reliable and provide the strongest barrier to future retests. This is because even with the large surge in volume, price was still unable to penetrate the barrier. This gives traders confidence that the price barrier should hold up on future retests. Since expectation is everything in the market, this goes a long way to garner confidence in the barrier. Support and resistance formed across a volume deep or trough is considered less reliable since the reason for price not being able to penetrate the barrier is mainly due to a lack of interest or participation at the price barrier. Traders were not interested in taking price through the barrier. Hence the barrier only held up due to a lack of buying or selling pressure. In fact, there are 5 possible scenarios of volume action associated with support and resistance, which are 1. Volume increasing across support or resistance. 2. Volume decreasing across support or resistance. 3. Volume peaking at support or resistance. 4. Volume bottoming at support or resistance. 5. Volume flatlining across support or resistance. Finally, flatlining volume across support and resistance. Finally, flatlining volume across support and resistance does not provide enough information about potential future action of price with respect to the barrier. Filtering volume action. There are numerous ways to filter volume in order to identify the most significant volume action, some of which include employing a moving average filter, a volatility filter, prior volume peaks, volume cycles. Setting up a smoothed volume filter. A smoothed volume filter is simply a moving average based on volume instead of price. To select the most effective look-back period, a simple backtest may be required to identify the amount of filtering that is appropriate for a particular trade setup. Volume filtered inflection points. Many practitioners also use volume as a means of filtering out price inflection points. They only use peaks and troughs that are considered significant, that is, those that are associated with above average volume, to construct trend lines and channels. Relative and absolute volume. Absolute volume is not as important as relative volume in technical analysis. It is the change in volume that provides the most information about potential price action in the markets. Many investors prefer Many investors prefer to hold on to losing positions in a falling market in the hope that the positions will eventually rebound to break-even or profitability. These participants are displaying what is called loss aversion bias. Investors and traders have the ability to use house money or profit to further fund new positions in a rising bull market. More investment funds start to market their services in a bull market, attracting more potential investors to participate in the market. Volume distortions. A surge in activities such as arbitrage, program trading, and high-frequency trading (HFT) may also distort and misrepresent the traditional meaning or representation of volume. As such, the volume information that traders use and rely on to read market action may not in fact be totally indicative of true volume action in the classical sense. Volume, open interest interplay. Open interest is simply the total amount of outstanding contracts in the futures and options markets. Open interest is therefore the number of unliquidated long or short contracts. Each contract consists of a long and corresponding short position. These contracts are in a sense still active or open. Open interest increases when a new long and corresponding short position are initiated, and decreases when both the long and corresponding short position are excited. Generally speaking, open interest is interpreted the same way as volume. It is indicative of the level of interest or participation in seeing price rise or fall. Open interest divergence is therefore read in the same way as non-price based volume oscillators. When prices, volume, and open interest are all rising, this is indicative of a bullish market predominantly driven by buying pressure. Conversely, when prices are rising but both volume and open interest are declining, this is indicative of a bearish market predominantly driven by shorts covering their positions and longs leaving the market. For declining markets, rising volume and open interest is bearish and is predominantly driven by short selling. In a declining market, traders should look for appropriate signals to go short if both the open interest and volume are rising, and rapidly seek to cover all short positions when both the open interest and volume start to decline together. Volume versus tick transaction. Volume in the over-the-counter (OTC) foreign exchange (FX) market. Exchange FX market. Many brokers offer tick volume instead of actual volume. One tick represents one trade. Tick volume therefore represents transaction volume. One transaction can be comprised of one contract or 1000 contracts. Although tick volume does not represent actual volume, there still exists a very strong correlation between actual volume and tick volume may be used as a proxy for actual volume as far as comparing relative levels of overbought and oversold. Breadth volume in the arms index. TRIN advances, declines equals, up volume, down volume. In short, a rising but not overbought tick and a falling but not oversold. TRIN represent a bullish signal where the trader looks for an appropriate long entry. Conversely, a falling but not oversold tick and a rising but not overbought TRIN represent a bearish signal where the trader looks for an appropriate short entry. For longer term trading, when tick is oversold, i.e., above its 2 sigma level on a weekly chart, and TRIN is overbought, i.e., near or above the 3.0 level on the daily charts, this signals a bullish scenario and the trader looks for an appropriate long entry. Conversely, if the tick is overbought and the TRIN is oversold, this signals a bearish scenario and the trader looks for an appropriate short entry. Two-dimensional volume analysis. We Two-dimensional volume analysis. We may also analyze volume two-dimensionally via volume by price, volume by time. Volume by time represents the total volume traded over a specified time interval or period. Volume by price identifies the total volume traded at each price level. Figure 6.27 depicts a large volume turnover around the $17 price level in SLV. This level therefore represents a significant support. Notice that this volume information is not obvious from conventional volume bar action. In figure 6.28, we see a lot of volume turnover between $77 and we may also use this two-dimensional form of volume. We may also use this two-dimensional form of volume analysis to locate the most significant support and resistance levels in the market. To do this, we first locate the largest volume by price range. In figure 6.29, we selected the $74 to $80 range as the range with the most significant volume by price. Volume volume to bar range spread relationship. The relationship between bar range spread and volume may also be used to forecast potential breakouts in reversals. 1. Narrow range on low volume rest bar indicates a potential for reversal, especially during a strong and rapid up or downtrend. 2. Narrow range on high volume reversal bar indicates a strong potential for a reversal. In an uptrend, price remains confined to a narrow range on very large volume. If the volume represented buying pressure, the range would be much wider. Hence, this is indicative of sellers attempting to take control. It is a bearish signal. The converse applies for downtrends. 3. Wide range on low volume reversal bar indicates a potential for reversal as the large price move was backed or supported by a relatively low amount of participation. It reflects a lack of interest. The longer the price bar on low volume, the more bearish it is in an uptrend and bullish in a downtrend. 4. Wide range on high volume continuation bar indicates a potential for continuation as the large price move was backed and supported by a very large amount of participation, that is, interest in seeing price continue. It is bullish in an uptrend and bearish in a downtrend. Constant volume charts are especially useful for pinpointing reversal bars on high or low volume. Since the volume is fixed, constant volume charts are especially useful for pinpointing reversal bars on high or low volume. Since the volume is fixed for each bar, it will be relatively easy to identify potential reversal bars by just referring to the bar range alone and its height in relation to the rest of the bars. Volume leading price versus price leading volume. Does volume lead price? Most practitioners will agree that without participation, that is volume, price will be unable to move in a significant manner. Nevertheless, technical buy and sell signals need not require much volume for them to appear on the charts. Volume cycles in the financial markets. We may anticipate potential price action using volume peak cycles that occur on an intraday basis in the markets. The intraday volume cycle normally peaks around 1:30 p.m. to 2:30 p.m. GMT. At these volume peaks, price will either reverse or continue, but very rarely remain unchanged. Volume on non-constant time charts as seen in chapter Volume on non-constant time charts as seen in Chapter 3. Some examples of non-constant time-based charts include point and figure charts, Renko charts, three-line break charts. The time axis is not plotted in a linear fashion for non-constant time-based charts. This affects the angle of geometrically based overlay indicators like trend lines, channels, and chart patterns. Equivalent charts are unique. Although each bar is based on a constant time interval, the width of the bars varies with respect to volume. To volume. 6.2 Volume oscillators. There are numerous volume-based oscillators and indicators, with some of the more popular ones being volume-weighted moving average (VWMA), accumulation distribution line (ADL), on balance volume (OBV), Chaikin money flow, Chaikin oscillator, demand index, Herrick payoff index, NYSE up-down volume line. We analyze oscillators for bullish and bearish signals using the 8th standard. Methods of observation. Refer to Chapter 8 for more on oscillator analysis. 1. OBOS over extended levels. 2. Equilibrium and zero line crossovers. 3. Signal line crossovers. 4. Price oscillator divergence. 5. Geometrically based oscillator pattern analysis. 6. Numerically based oscillator pattern analysis. 7. Horizontally based oscillator pattern analysis. 8. Oscillator on oscillator analysis. Price-based volume indicators, the OBV and 8D line. The on-balance volume (OBV) oscillator is simply a cumulative or running total of each period's volume added or subtracted from a running total depending on whether the current period's close is higher or lower than the preceding period's close price. Nevertheless, this does not affect the changes in the relative value of the OBV line. As such, all 8 oscillator analysis methods may still be employed to determine bullish and bearish signals. One major weakness of the OBV oscillator is that the current period's volume is added or subtracted from the cumulative total regardless of the current period's price behavior. Price-based volume indicators. Price-based volume indicators, the Chaikin money flow and Chaikin oscillator. The Chaikin money flow, CMF, is calculated in a manner similar to the ADL. First, calculate the value of the multiplying factor, C minus L minus H minus C, H minus L. Current period's volume. Let this value be S. Then calculate the n period sum of S and divide this by the n period sum of volume. This will represent the n period CMF. Just as for the ADL, create a running total for CMF. The Chaikin oscillator is then calculated by simply subtracting a longer term EMA from a shorter term EMA of the running total. In figure 6.43, we see the Chaikin oscillator generating an earlier sell or bearish signal when compared to the CMF. We also see the oversold levels on both oscillators indicating a potential market bottom in copper. Around the month of October 2011. Non-price based volume breadth indicator, the NYSE. Up-down volume. The NYSE up-down volume indicator is the ratio of advancing volume over declining volume. Being non-price based, divergence is read in the same manner as for volume bar action and smoothed and detrended volume. Open interest indicators, the COT report and Herrick. Payoff index. The Herrick payoff index uses open interest in its calculations. As such, it may only be used with futures and options. It incorporates price in its calculations and, as such, divergence readings should be observed in the same manner as all other price-based volume oscillators. 6.3 Chapter Summary. In this chapter, we have observed how volume and open interest play 6.3 Chapter Summary. In this chapter, we have observed how volume and open interest play a critical role in helping to decipher potential price and market action. We have also seen how price-based volume oscillators are interpreted differently from non-price-based volume indicators. We shall be applying most of what we have learned in this chapter, with particular emphasis on volume divergence and filtering volume action throughout the rest of this handbook. Chapter 7. Bar Chart Analysis. 7.1 Price Bar Pattern Characteristics. Construction of a price bar. A standard price bar comprises an open O, high H, low L, and close C price. Normally referred to by its acronym OHLC. Price activity may be quantized over a specified duration or time interval and summarized into OHLC data. For example, Figure 7.1 depicts 5 minutes of price activity, which may be represented by a bar. The range of the bar is simply the absolute distance between the high to low H minus L. To summarize price activity over longer durations, comprising multiple intervals, simply use the opening price of the first interval, closing price of the last interval, and the highest and lowest prices over the entire duration observed. Classification of price bar formations. There are 3 basic ways to classify price bar formations, namely via 1. The number of bars that make up the formation. Single bar formations, double bar formations, triple bar formations, multiple bar formations. 2. The intrinsic bias or sentiment associated with the price bar formation. Two, the intrinsic bias or sentiment associated with the price bar formation. Bullish formations, bearish formations. 3. The directional expectations of the formation. Continuation formations. Reversal formations. 7.2 Price bar pattern characteristics. Bar reversals and continuations may be classified in single, double, triple, and multiple. Bullish and bearish patterns. A bullish pattern in an uptrend and a bearish patterns in a downtrend are considered to be continuations patterns. Intrinsic and trend sentiments agree, the pattern is considered a continuation pattern. Intrinsic and trend sentiments disagree, the pattern is considered a reversal pattern. We say that the trend sentiment is bullish for uptrends and bearish for downtrends. Intrinsic sentiment is the inherent bullish or bearish bias that is associated with a particular pattern. For example, the intrinsic sentiment is bearish for a standard head and shoulders pattern and bullish for an inverted head and shoulders pattern. Hence, an inverted head and shoulders pattern in an uptrend is considered a continuation pattern since the trend and intrinsic sentiment are both in agreement, that is, they are both bullish. For more on intrinsic sentiment, for more on intrinsic sentiment bias, that the existing trend is up with the reverse for bearish patterns. 7 Generic single and double bar bullish and bearish reversal formations. In figure 7.4, we see various single and double bar bearish reversal patterns occurring in an uptrend. As a general rule, a close below a previous bar's close or low is considered bearish, especially if the previous bar is a large or wide-ranging bar. Narrow range bars occurring within a 2 bars pattern should generally be formed on low volume, indicating uncertainty in an uptrend. Large bars closing at or near their lows should generally be formed on high volume in an uptrend. In figure 7.5, we see various single and double bar bullish reversal patterns occurring in a downtrend. As a general rule, a close above a previous bar's close or high is considered bullish, especially if the previous bar is a large or wide-ranging bar. Narrow range bars occurring within a 2 bar pattern should generally be formed on low volume, indicating uncertainty in a downtrend. Large bars closing at or near their highs should generally be formed on high volume in a downtrend. 6 generic triple price bar reversal formations. In figures 7.6 and 7.7, we see 6 basic triple bar bearish reversal patterns occurring in an uptrend. As a general rule, the larger the gaps, the more bearish will be the pattern upon completion. Also, the larger the range of the first and third bars, the more reliable will be the reversal pattern. For most triple bar patterns, the middle bar usually occurs on low volume, except possibly for pattern 1 where larger volume is also considered more bearish. This is because the buyers failed to keep the closing price near or above the midpoint of the bar and instead allowed the sellers to drive price to close at or near the low of the bar. A bearish 3-bar pattern is generally considered more reliable if the last bar is an overextended bar that closes at or near its low on high.